NYCERS meeting? Chair. Here. Controller's office.
Here.
Public Advocate's office. Here. Borough President Manhattan. Borough President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters.
Yes.
Transport Workers Union.
Here.
District Council 37.
Here.
Got a quorum. Okay. Over to you, Larry.
I think we're going to start today with a macroeconomic review from JP Morgan. Does anyone know if they're here?
They are here.
Okay, let's start with that.
We'll start with what?
Yes.
Well, Larry, do we just want to tell everybody how you're going to work the agenda for the morning so that...
Sure. What we'd like to do is go through, have a macroeconomic review, then go through the monthly performance. Then we have to talk about asset allocation. Then we'll talk about the controller's proposed reorganization of investment card.
I would object to changing the order of the agenda. The agenda I got with the issue of controller's reorganization is first on the agenda.
Larry, if I may,
Yeah.
we were under the impression that some trustees couldn't arrive until 3:30. So that was, we reacted to something that was sent to us as part of the schedule of other trustees. We weren't the ones who changed that timeline.
No, but the request was, number one, the trustees who made that request are here. Number two, the request was to simply lay over the first point to make it the second point on the agenda, not make it last in the public session.
I think the goal was to lay it over till 10:30. So the people who are going to give the presentation now expect to be here at 10:30 because that's what they were asked to do. So we will do it at 10:30, but finish whatever agenda item we're working on until that point and then start doing it.
So, with that, go ahead, JP Morgan.
Does it matter?
Send comments on memos. Our emergency.
Okay, we're ready to go?
Well, good morning, everyone. I don't know if you'd like to do this.
Hi, good morning. I'm Lauren Zusi from JP Morgan Asset Management. We're excited to be here today. I'm excited to present Rebecca Patterson, our Chief Market Strategist for our global institutional business. Rebecca is also head of our client advisory team. I can't think of a better person to speak to you this morning on the European situation right now, as she has a very unique background. She has experience in our investment bank and private bank with currency commodities, has spent time working both in Europe and Asia. She's often quoted in the media and is a co-host of CNBC's Money in Motion, a weekly currency show. So can't think of a better person to speak to today. Rebecca will present on the topic and then we'll leave room for Q&A towards the end.
Great, and thank you to on my part for allowing us to come today. It's a hugely important relationship for us, and we're just very happy to be able to partner with you on different issues and help make sure you're up to speed on what is a very unusual time in our global economy. So let's dig right in, if you don't mind. We'll go to slide 2. And please interrupt me if you'd like during the discussion. I will make sure we have time for Q&A at the end. If there's a question or comment along the way, again, please don't hesitate to just jump in. So I'm going to try to cover a couple of things here, just kind of where we are with the European crisis now. What are the spillover risks? You know, I'm actually surprised how many clients I talk to who say, I'm tired of talking about this, why do I need to care? So I think it's important to understand the transmission vehicles from Europe to the rest of the world, so we do understand how this affects all our assets, not just the possible European assets. And then I want to just give a very, very quick recap of some of our base case views looking at the year ahead, both for macroeconomics but also investment strategy. So if we can go to slide 3. Lauren mentioned that I've spent some time in Europe. I was actually living in London when they were writing the Growth and Stability Pact. And that was the agreement among the European leaders to have budget GDP ratios of 3% and debt GDP ratios of 60%. And at the time, I was a journalist. I've been with Morgan for 15 years, but in my previous life, for about 8 years, I was a reporter. And at the time in London, I was working for the Wall Street Journal covering European politics and financial markets. So I spent a lot of time in the run-up to EMU actually following this from a different perspective. And I remember being in Dublin at one of these summits, and there was a huge fight, literally a verbal fight, but a loud fight between the German and the Italian finance minister on what the debt GDP ratio should be. And the Germans wanted a 60% cap, the Italians wanted a higher cap, and at the end of the night, and these events always happened after dinner, so they'd have a nice, very European-friendly dinner, and then we'd have the discussions, and literally around 2 a.m. in Dublin, the Italian finance minister fell asleep. And so the Germans got their way, and you see where that leaves us. So let's look at slide 3, because I think this tells the story. Look at the top right slide. So the brown line is Germany, the blue line is Greece, Ireland, Spain, and Portugal, so a slice of the periphery. And what is important, I think, to me here is that in the run-up to the start of EMU in 1999, all the European countries were trying to harmonize. They were trying to meet these Maastricht Treaty guidelines, and so they were behaving very well. Everyone was trying to bring down their inflation rates, bring down their local interest rates, get their debt and deficit houses in order, but that harmonization wasn't followed as closely, let's say, after EMU started. So it's like you work really hard to get your grades up to get into a college, and once you're in, you just party and drink a lot of beer. It's kind of like EMU. So what we've seen is that as they didn't have as much impetus to stick to the Maastricht Treaty after they joined, we saw some discrepancies both in some of the debt and deficit dynamics, but also the growth dynamics. And looking at the bottom chart on the left, you can get an idea of this. This is just in recent years, but Germany has had a very nice recovery since the crisis in 2008, 2009, and a lot of that has to do not with Europe, but with China. So Germany is 50% export. 50% of its GDP comes from exports, and it now exports more outside of the euro area than inside. And a lot of its goods have been going to emerging markets, and specifically China. And as Chinese growth has moderated but stayed at a relatively high level, that's given a support for Germany, at least until very recently. So you can see the discrepancy between growth in Germany and growth in the periphery there. And that gets me to the next page. As we've had these discrepancies in growth, so stronger growth in Germany and the core of Europe, weaker growth in the periphery, weaker fundamentals in the periphery, the trigger for the crisis really, just as a quick kind of history recap, in late 2009 we had the Greek elections. Papandreou was elected and came out and announced, oh, by the way, the numbers the previous government told you on our debt and deficit were incorrect. Here's the real numbers. And they were extraordinarily different. And that's when the crisis kind of first started. We realized quickly that Greece needed to get back closer to the Maastricht Treaty. So it needed to tighten fiscal policy. It needed to cut spending. It needed to raise taxes. Okay, so far so good. Why hasn't it worked? Why do the markets just remain skeptical about what's going on? This chart on slide 4 is worth me explaining a minute. It's a little funny looking, but I think it actually really helps explain the story. So each of the bubbles on this page is fiscal tightening enacted by a country. And the bigger the bubble, the greater the fiscal tightening. Now what you see on the horizontal axis there is how much the currency of that country declined, depreciated during the fiscal tightening. And then on the vertical axis is growth of that country during the fiscal tightening. So what normally happens? When a country decides it's going to reduce its deficit, that slows down growth at the margin. You're cutting spending, you're raising taxes. Generally speaking, austerity does not create growth, even though some politicians here in the States like to think it does. Austerity tends to weigh on growth, and that's what we've seen throughout history. So to try to cushion that blow, central banks will cut interest rates, make borrowing costs cheaper, And cutting interest rates also makes the currency weaker, usually, and then the currency is more competitive and you export more. And the combination of lower borrowing costs, greater exports tends to provide a support to growth. So what you see with these bubbles is that in general, when you've had major fiscal tightening in the past, all around the world, you've had pretty big currency devaluations. I mean, 40, 50% falls in the currency. That's not a small deal. But that has helped support growth. Now look at the orange bubbles on the left. That's last year for the periphery. So last year we saw the euro strengthen. Last year we saw the ECB raise interest rates. So big surprise that we didn't have growth. We had contractions. We had recessions for Greece and very low growth for a number of EMU countries. Now if you go to the next page, what have we seen this year? So euro dollar this morning is trading around 135, 136. It's basically flat year to date. So we're not getting much help from the currency. Since Greece crisis started in late 09, the euro's fallen about 4%, both against the dollar and on a trade-weighted basis. So this big depreciation to help, not happening. Part of that, bless you, part of that has to do with the ECB, the European Central Bank. Now Draghi, since he took office at the start of November, has cut rates once by 25 basis points. We're going to get more, we think, and we need more. And we need a weaker euro. Those things would definitely help in terms of stabilizing these markets. Let's go to the next slide, slide 6. Now, if we're not getting much help yet from the euro itself or from the ECB, could we see other ways to help with the process? Now, one thing that the IMF and the European Union and the ECB are pushing these countries to do is get more competitive, reduce their wages, make their economies more open, make it easier for people to move in and out of different labor markets, different sectors. So look at the chart on the left. I think this is an interesting one. So this is unit labor cost. You can see in Germany relatively low. Ireland, that green line at the top. So Ireland is kind of off the front pages right now in part because it already took some steps. Ireland has already addressed some of its banking problems. Ireland has taken meaningful steps to cut public sector jobs and to reduce wages across the board. And so you're not seeing as much contagion to Ireland anymore as you're seeing to other peripheral countries because they're further ahead in the process. But then look on the right-hand chart here, just governance indicators from the World Bank. You can see part of the reason why Italy is so in the spotlight today. It's not just the fact that they have a debt-GDP ratio of 120%, and they can't service interest payments when their bond yields are so high. The 10-year yield is back above 7% today. They just can't afford to service that debt with yields so high. They have to bring down the yields. And people are reluctant to buy into the Italy story because they see that the labor markets are very rigid, that you have difficulties collecting taxes, that you don't have a lot of political credibility, even with Berlusconi gone. It's going to take a while to fix that. And you have perceptions of a great deal of corruption, which gets back a little bit to the tax collection. So there's a lot of cynicism that Italy can get it together. So here we are. The markets are skeptical about Greece in particular, but Greece is only about 2% of euro area GDP. So while Greece is important from a sentiment point of view and from a contagion point of view, in terms of the actual economy, it's kind of a drop in the bucket. But Italy is between 15 and 20% of EMU. It's GDP. So the economy poses more systemic risk issues, both to Europe and I'll get in a minute to the rest of the world. And when we saw Italian bond yields going above 7%, that was a big kind of aha moment for a lot of European policymakers, is that we have to get this under control. Because even though a lot of people have reduced their exposure to Greek debt, there's still a lot of Italian debt held out there right now. So what did we get from the Europeans at their October summit? So we got three main things on page 7 here. They announced that the European Financial Stability Fund, now this is a fund that the European governments are saying they're going to give money to. There's pledges, and that money can be used to help both peripheral government bond markets, but also through the government's banks. So we can help stabilize the peripheral government debt markets and the banks through this fund, the EFSF. But it wasn't big enough. It was big enough for Greece and Portugal and Ireland sovereigns. It wasn't big enough if you added Italy and, God forbid, Spain there, and it wasn't big enough if you had sovereigns plus banks. So they knew they needed to get more firepower from this. So they said, no problem, we're going to lever this up. We're going to take this baby from 440 billion euros, and really only about 250 was left to be used, to $1 trillion or more. Okay, sounds good. Sounds good. We're going to get back to the reality in a minute. They also announced that they were going to make the European banks recapitalize. So if we're worried about contagion via the banks, we need to make the banks' balance sheets stronger so they can withstand this. Okay, sounds good. And then we're going to write down Greek debt. So we're going to write down Greek debt by 50%. So those were kind of the three big takeaways from the summit. The day after the summit, the German stock market rallied 7% in a day on optimism around this. The week following, the DAX went down 7% as reality set in. And what is the reality? Well, the EFSF, they said they were going to lever it, but they didn't really give you any details on how they were going to go about this. And where we are today, 3 weeks since, it's completely fallen apart. They had talked about potentially creating a special purpose vehicle that sovereign wealth funds could put money into. I was in Asia when this happened, and I was meeting with some of the sovereign wealth funds, and I said, have the Europeans asked you to put money in this? Oh my goodness. So Europe went public saying Asia's going to bail us out. Asia's going to save Europe. They didn't ask Asia before they went public. So, it's sort of, kind of amazing. One of those kind of basic common sense things. So, pardon my language, but they pissed off Asia. All these sovereign wealth funds said, we might give money, but we're even less excited about giving money today than we were before. And so, yes, please.
Why were they pissed off?
Because they hadn't been asked ahead of time to go to the world, to go to the news wires and say, Asia's going to give us $1 trillion, or I'm making up a number, but they're going to give us a lot of money. But you didn't have the respect for Asia to go to them ahead of time and say, we would like to announce this. Do you think you might be on board? They didn't bother to have that little conversation.
It's important.
Yeah, kind of. It's like asking for your wife's hand in marriage. You go to the dad first.
Yes.
They didn't go to the dad. They just went straight to the New York Times and put in an ad. So, all right. So that didn't turn out very well. I think there's still a good chance that some of these sovereign wealth funds give money to Europe, but they are going to get a pound of flesh. So what we think is happening behind the scenes is that China, Russia, some other fairly wealthy emerging market countries are going to give more money to the IMF. The IMF will then use that money to give to Europe. But they're going to get something for it. They're not given a handout. What they're going to get in return is greater voting rights at the IMF. And voting rights in the IMF, it's a zero-sum game. You have so many votes to give away. So if China gets more votes, guess who's going to give up votes? Europe. So Europe is going to succeed power to China, basically in return for its money. I think there's some other things being negotiated, but that's probably the one I can talk about publicly. So the EFSF is sort of dead on arrival right now. We think they're still trying to get it going, but it's taking a lot longer and has been a lot more cumbersome than they expected. The bank recaps. Well, you've already heard from a couple European banks that they don't think they need to recap. And it's not clear if this will be forced. So like in the U.S. case, the banks were forced to take money. JP Morgan was forced to take money, even though we said we didn't need it. The European banks aren't being forced to do anything at this point. So what happens if June next year they haven't recapitalized? Does it matter? Who's going to say something about it? The other thing that we see anecdotally happening right now is that banks trying to clean up their balance sheets, rather than selling risky assets, illiquid assets, they're doing a lot of what we saw in 2008. So if you remember back to the crisis, you saw a lot of fundamentally sound assets being sold. Brazil in 2008 was a great story. It had high yields, it had a current account surplus, it had strong growth, and yet the Bovespa and the Brazilian real fell like a rock. Well, why is that? Well, partly because it was liquid. If I was a hedge fund in 2008 and I owned a lot of Kazakhstani debt and I owned, a factory in the middle of Nigeria, I don't have a bid-offer spread in the middle of a crisis. I can't sell it even if I want to, but I can sell my Brazilian stocks because it's a liquid market.
And so we're seeing the European banks do the same thing now. They're selling what's liquid. So what are they doing? They're selling Italian bonds, French bonds, and that's creating a bigger problem because it's pushing up yields of these markets more, and it's pushing all this stuff onto the ECB. The ECB wanted these banks to get rid of other stuff, but risky stuff, and they're getting rid of the stuff that's less risky. So they're actually not lowering their overall risk ratings, they're raising their risk ratings, and they're adding to the problem for Italy. So that's not going so well so far. And then the Greek haircut. So the difficulty with the 50% haircut, basically it felt like they got an Excel spreadsheet and did a solve for. Like if we want to get debt GDP to 120% in 10 years, how much haircut do we need? 50%. Ding, ding, ding. That's our number. So they did 50%. But again, let's think about this. In 10 years, the Greek debt GDP ratio will still be double the Maastricht Treaty guideline and an unsustainable level. So if you're Greece, what do you do here? You're going to endure years of recession, years of declining quality of life, falling wages, fewer government services, and at the end of it, you still have a debt GDP ratio of 120%? So is it so shocking that some in Greece are now actively talking about maybe we should go back to the drachma? We're having a difficult time inside Morgan figuring out what our view is on this, but I can say personally, and I can say increasingly the conversations we're having is 50% isn't enough. Greece will restructure again or just default. And I think personally, there's probably a coin flip whether Greece stays or leaves EMU in the next 2 years. They know the price they're going to pay if they leave. They're going to go back to the drachma. There'll be an emerging market. They'll probably have a period of stagflation, much higher borrowing costs. But they stay in Europe, and they're going to have a prolonged recession. They're still going to have a high debt GDP ratio, and they're going to give up increasing amounts of sovereignty to Germans, which politically doesn't go over very well. So which one's worse? And the math is getting more and more balanced by the month. And so the chance of them leaving, I think, is very real. The good news is that exposure to Greece now is so limited that the spillover from that event, if it were to happen, I think is relatively limited as well.
Rebecca, there isn't a compromise path where they stay within the European Union, just not part of the currency union?
I said EMU, right. So good point. They're different, right? EU is 27 countries. The UK is in the EU, but not the EMU. They still have their own currency. I think you're making a really good point here because Greece or another country, even if it left EMU, would probably try to hold on to some of the credibility of the broader institution and the benefits of the broader institution by staying in the EU. So one thing that's been talked about by some of the far right-wing parties in the Netherlands, which I don't think is going to ever happen, but it's becoming a conversation, is the euro, the new euro. And the euro would be composed of Germany, France, and the Benelux, maybe Italy, but it's not clear. And they're saying we should get rid of all the peripheral countries, and they can be the minor euro or the B team, and we'll have the euro, which is this core currency, which has stronger fundamentals and the real players. Everybody would still be in the EU, but now you might have actual two currency unions within the EU as part of EMU. I don't think that'll happen. The fact that the discussion is happening, though, to me is quite important. But yes, I think even if Greece left EMU and went back to drachma, it could and probably would want to stay in the European Union. So let's talk very, very quickly about some of the politics here. So Italy, because it is affecting the markets. So Berlusconi finally resigned. I actually lived in Italy when he was first running for office. He didn't hit on me. He doesn't like blondes. So good for me. But I covered his campaign back in 1994, and it's extraordinary that he's been in power so long. The difficulty is he's not leaving easily or quickly. His party, the People's Party, has said today that they won't give the new Prime Minister designate Mario Monti blind support. So he's going to have to play ball with Berlusconi's party. In other words, Berlusconi is still going to be pulling the strings. And then the Northern League, which is another very important party headed by Umberto Bossi, is not supporting Monti at all. So great, we got rid of Berlusconi, we got this technocrat, former EU commissioner, head of a very prestigious university in Milan, but he doesn't necessarily have the politicians behind him, so how much more effective is it going to be? Is there any real difference here? Like, even if he has better ties with the Troika, the ECB, the EU, IMF, if he can't get people to vote for the austerity, we're no better off. And I think that's part of the reason Italian bond yields are still so high. We'll probably have elections in Italy at some point next year, and that's a question too. Do we just get Berlusconi's stooge coming in to take over from him without trying to put names to that adjective, which I probably shouldn't have used. In terms of Greece, so again, we got a new head. We got Papademos coming in, also a technocrat. Good news. But similarly there, the political posturing doesn't go away. So the head of the opposition party, Mr. Samras, came out and said he refuses to sign the letter of the government backing new austerity measures that's required for Greece to get more money. Greece runs out of money in December, runs out. They have some large bond payments. So far they've been finding nickels and dimes to keep things going, but they have some big bond maturities in December. They need the aid before then. And I think the opposition leader is just posturing. He's trying to get some concessions from the new government. But this is a problem. You know, if they can't get the politicians on board to move the ball forward, it doesn't matter who's in charge. So the politics here, a step forward, having new leaders, but it doesn't fix the bigger issue. And then just to add to this, on page 9, worth remembering that these are not the only countries with politics going on. We have elections this Sunday in Spain. We have elections in April in France. We have elections in January in Finland. Spain, I don't think the election's a big deal. The opposition party is going to win, widely expected in the polls. They will continue with the austerity. The difficulty for Spain, also a systemically important economy, a much bigger economy, is that the unemployment rate nationally is 20%. Among 30 and under, it's 50%. So again, you're talking about strict austerity, weighing on growth, making a lot of young people out of work and unhappy. So you have a social unrest issue. In the case of France, it's going to be a tight race. I think regardless of who wins, some of the fringe parties are going to affect the policy making in the center parties. And while they will keep helping the periphery, because it's important to France's economy, they're going to have to make a lot of noise to pander to their voters. So it's going to be noisy, and that's going to keep volatility heightened. And a similar situation in Finland. So before I get on to spill over to the rest of the world, let me just give my big takeaways on Europe. We think the euro area is going to have a mild recession, probably starting in the current quarter and lasting throughout next year. We think in 5 years' time you'll still have a euro, and you'll still have an EMU, a monetary union. But as I said earlier, it's really not clear to us if the membership changes within that union, and Greece is the one we would look out for. We think that some Americans underappreciate that EMU is not just a convenience issue. This is something that started with the coal and steel union in Europe in 1951. There are generations of politicians that have staked their reputations on building this, on getting where we are. So they don't let it fall apart easily or without a fight. So while this is a really messy political process, we do think we'll get to the other side. But it's going to take a long time because you have to have 17 countries agree on every step of the way. I mean, think about how long it takes New York City to agree on a big project. It's hard to get all the players on the table. Now times that by 17, right? So it takes a while for them to get consensus and to move forward, but we do think they'll move forward. But because of the politics, because of the fact that growth is such a headwind, we think the volatility in Europe is going to stay, and we think the crisis is not over. So what does that mean for the rest of the world? If you go to slide 10, this is just a reminder on the left. I'm looking at the U.S., the S&P. About 30% of S&P revenues come from overseas today. Again, it's always striking to me when people say, oh, well, we should just buy U.S. stocks. It depends on the company, of course, and it depends on the sector, but more and more, it almost comes to me like asset allocation shouldn't really be about your country, because most of the assets you're buying have exposure to lots of countries. So you almost need to think about it more thematically, an inflation bucket, a real return bucket, a real estate bucket, than a country bucket, because the borders on countries in terms of your investments, in my mind, are blurring very quickly. But the bottom line is a lot of U.S. companies have exposure overseas and including to Europe. If you look at the chart on the right, you can see Italy is the one you got to watch out for. The U.S. has about $13 billion of exposure just to Italy government bonds. That's not even including the private sector. So if Italy goes down, we're going to feel it a lot here through our banks, through our money market funds, and through revenues of U.S. companies that are selling products into Europe. So there are some very serious transmission issues here. I don't think Italy goes under. I think Europe will ring fence it, but I think I have a chart on the next page that explains how we have to solve this. As I mentioned before, the ECB is a big player here. I think the ECB will feel better about cutting rates more aggressively going forward because growth is now slowing so quickly and inflation appears to have peaked. But it's not just about cutting rates. They have to provide liquidity and they have to become a greater vehicle intervening to stabilize bond markets. The Germans have been very much against that, but at the end of the day, I think the crisis will be bad enough that it'll force their hand. I think that the IMF and the EFSF, in one way or another, are going to be playing a bigger role, and that'll include with capital from emerging markets via the IMF. I would expect we'll get the IMF in Italy before the end of the year with some sort of package. Now that we have the new technocrat government in place, once it's officially formed, I think that'll open the door for the IMF to get involved with Italy, which will be a good thing. Bank recaps need to happen. You know, the banks in Europe are quite a bit more levered than U.S. banks, and they're much more reliant relative to U.S. banks on retail deposits. So runs on banks, deposit flight is a much bigger risk there relative to here. They need to get their banks in order. Just this morning, we saw 2 major French banks down 6% in one day on the back of worries of contagion. And then Greece, again, I think a 50% write-down on Greece is not enough. I think it's going to have to be happening again, or at the end of the day, Greece defaults and or leaves EMU. Greece isn't done. Again, the good news is the bonds are only trading about 30 cents on the dollar, so a lot of bad news is priced in. If you think Europe's going to be a big focus next year with politics, if you go to page 12, so one of the things that has been interesting to me throughout this year has been the politics. When you think about the Arab Spring, pushing oil prices, Brent, to 126 a barrel, and forcing the International Energy Agency to releasing strategic reserves, I mean, that's extraordinary. You think about the debt ceiling debate, the U.S. downgrade, very politically driven, or influenced at least. You think about what's going on in Europe, politics is playing a major, major role in the markets. And when I look at 2012 and I start kind of thinking about what might happen in the world next year, how we want to position portfolios, there are elections in a number of countries next year representing half of the world's GDP. Now, elections happen all the time. But to have elections in this many important countries in a fairly limited time frame when the world is as fragile as it is, that to me is striking. And this is just a reference page on some of the elections that we'd be looking out for. In terms of what it could mean for markets on the next page, I think there's a couple things I'm focusing on. We already talked about Europe, and in the interest of time, I won't go further into that. But I think there's a couple other things to watch. One is on oil prices. So we have elections in Egypt, we have elections in Venezuela, we have elections in Russia. And even though global growth is likely to slow next year, I think there's upside risk to oil prices. And I think this will happen because of supply from 2 fronts. One, as Egypt's not a major oil producer, so why could Egypt affect oil prices? If the elections in Egypt don't go well, either because the new guard is too similar to the old guard, or the military rulers right now try to cling on to power longer than they should, that's going to create, I think, broader worries about these Arab Spring political transitions, and that could create a supply risk premium for oil. I think more importantly, whether it's Russia, Venezuela, Saudi Arabia, Iraq, a lot of economies use these oil revenues to create their budget surpluses. Saudi Arabia this year alone, in 2 months, spent $130 billion to buy peace. They gave out $130 billion in subsidies in 2 months to make their populations happier, right? So they didn't have their own Arab Spring. How do you sustain that? You have to have oil prices high enough that the revenues keep coming in, that you have a budget surplus. So if oil falls too far for a sustained period, these governments face serious risk, and they know it. Kuwait actually came out about a month ago saying it needs oil at 96 a barrel to balance its budget. It's very unusual for an oil country to actually give you a number like that. The fact that they're doing it tells me something. So I think if oil prices were to fall too far, they would intervene verbally at first, but actually is possible as well. So I think oil risks are asymmetric. China, Korea, Taiwan, this is more of a regional issue, but you have elections in Taiwan and Korea next year, and I would just be aware that there is some geopolitical tension risk out there, especially tied to North Korea and South Korea, that could keep volatility high and affect regional assets, at least on a tactical basis. And then, of course, with China's transition and the U.S. election, just given the size of these economies, any policy changes in either place or policy uncertainties are going to be impacting markets. And in the U.S. case, obviously, Canada and Mexico more than others, given trade ties. So let me just summarize here. 2 more pages and I'm done.
Something on the page you just on.
Yes.
Which of these countries is upset?
Upset in a political sense? Excuse me. Well, let me go back to page 12 then. So you're going to have a new government in Spain, so the party's turning over. Egypt, it's almost irrelevant. You have a military transitional government now, so you will get a new government there. Taiwan, the polls currently show that the race is very close, and the opposition party is less enthusiastic about mainland China ties, so that's a good one to watch. Finland, the only interesting thing there is that this very anti-European party has gained a lot of traction and is influencing the main parties, but I don't think you have an upset. Russia, we know the winner already. And that's a good thing, actually, because you don't have policy uncertainty. But yes, it's good for us as investors. The bad thing, though, is that he could use control of the commodities that Russia exports, especially to Europe, as a tool of influence. Korea, I think there's a good chance you have a new government there. The 2 parties are fairly similar, but the opposition party that could win wants to take a harder stance on North Korea. Hong Kong, close race, both of them close to China. France, close race. It will go to a second round. I don't know who will win that. The opposition candidate, who is a socialist, Francois Hollande, wants to pursue austerity. I think the only difference is how do you get the austerity? He's more in favor of raising taxes. Mexico does look like you'll have an opposition government coming in. Venezuela, depends if Chavez is alive. China, obviously new government, but no policy change in the short term. One of the reasons we like China and Asia so much in a relative basis for the next few years is that again, like you said, it depends if you're Russian. Well, it depends if you're Chinese. But during a political transition in China, it's very orchestrated. It's completely different from the United States, where we have the campaigns and the uncertainty over who's going to win. We know who's going to come into power in China. We already know the 2 top names. We know their backgrounds. We know that all the trickle down to the other people who are going to get jobs elevated is already decided, basically. And what China likes to do during these periods is just have stability. They don't want anything rocking the boat. So they're going to try harder than usual to have as stable as possible growth and inflation and markets, because they just want this period to go well. The outgoing leaders want to be able to pat themselves on the back. The incoming leaders want to hit the ground running. And so when I look around the world at all this political uncertainty, China to me is one of the few places in the world where I say the political transition there actually equals certainty, at least from a certain point of view. Now, 10 years from now, this new generation of Chinese leaders, are they going to liberalize faster? Are they going to turn more inward? We don't know. They're new. But for the next year or 2, I think there's a very strong case to make that they just don't want to rock the boat. And from an investment point of view, that's a good thing. Chinese growth moderating to 8% or 7.5%. Yes, it's a slower growth pace, but that's pretty good given the world environment. And they'll continue following their 5-year plan. So to me, that has trickle effects to the rest of Asia and to their big exporting partners, places like Australia, Chile, bless you, Brazil. So I guess to answer your question, one of the interesting things about 2012 is how many countries we're going to see new leadership. Like most of those countries I just walked through are likely to see new leaders, new parties in charge. which means potential policy shifts, maybe big, maybe little, but that does create a level of market uncertainty, which to me, at a minimum, suggests that the volatility we've had this year is likely to stay next year too, which kind of stinks, but it is what it is. Sell puts. Okay, so we covered that. Let me just go to my summary pages, please. Slide 14. So I already talked about oil a little bit. You know, the risk around higher oil, I mean, great to have higher oil prices if you're long. The risk with higher oil prices, obviously, is that if you get to certain levels and it feeds through in the U.S. to retail gasoline prices, it can actually weigh on consumer sentiment and actual consumption. So you have to watch that balance. 2009, rising oil was great. It was rising alongside with a recovering economy. Stock markets were going up. You made money in Exxon. You made money in oil indices. But 2011, oil going up was not good for risk assets. The euro area, the crisis continues. I don't think Europe implodes, but I think the politics will be a factor that make this very drawn out and messy. We're happy to sell euros. We think the euro will probably go down towards its fair value of 120. We think there are opportunities in Europe, especially in distressed credit, as the banks delever. But in general, we certainly would not be chasing yield in Europe at this point. In the U.S., you know, J.P. Morgan does not try to predict elections. We do think the super committee next week is going to disappoint. We're looking for a 1.2 or 1.5 trillion package, so the minimum. And the growing chatter seems to be that with the tax revenue increases, they're going to delegate it to a committee, which I just find, you know, just embarrassing as an American taxpayer that they can't make the decision. So they're saying, yes, we're committing to $500 billion in tax revenue increases, and these people over here will figure it out in the next year. And it seems like that's probably what we're going to get. And that makes me nervous because I think it does raise the risk, at least, that we have another rating downgrade over the next 12 to 18 months. Our debt GDP ratio is going up. We're showing no improvement in our political commitment to change our debt dynamics, and we think U.S. GDP will be between 1% and 2% next year. So it's not a great combination to have a better ratings outlook. Asia, again, one of our preferred regions, both in terms of relative fundamentals, growth, and politics. You know, I look at Asia, take India out for a second. Every country has a current account surplus. The average budget deficit is about 3% of GDP. They have huge foreign exchange reserves, and their currencies are fairly or even slightly undervalued. That's somewhere I'd like to be in this environment. And then lastly, just on a global basis, again, with all of this uncertainty, I think you just have to expect that the volatility we've experienced this year is lingering for a while. So those are kind of the macro views. And then the last page is some of our key investment themes. But given an eye on time here, maybe I'll stop and just see if there are any last questions, either on investment strategies that we're following or anything I said or didn't say. A lot to chew on. Please.
I'm actually interested in your key investment things.
Okay. Okay.
It's nice to hear about what's happening in Europe, but we have a practical component.
Absolutely.
Why we're here.
So when I put together everything I just talked about for the last 30 minutes or so, you know, on the equity front, I think that political and regulatory and other types of uncertainties, as well as limited growth in the United States, I think those factors will help put a limit on equity upside, at least for the next year or so. However, I think the lack of exposure to the market, whether you're looking at cash on the sidelines held by retail clients or corporate clients, that plus valuations also suggest that we have a bottom for stocks. I don't think we have a repeat of 2008, even if Europe gets worse. So we expect to see U.S. equity markets at least fairly range-bound in the year ahead. But that doesn't mean you get rid of all of them. It just means you need to be smart on how you allocate. And while I think it's increasingly a consensus view, we still subscribe to the high dividend strategy. You know, if you can get 2% on an S&P average dividend yield, and that's equal to your 10-year Treasury yield, it changes the math a little bit on stocks versus bonds. And so we look at high-yielding U.S. companies that have good balance sheets and have the ability to grow that dividend further. That is one area of focus for us. We're also looking at U.S. companies that have exposure to overseas and particularly Asia, not Europe. And there are plenty of those companies, actually. And a lot of those companies happen to fall into the large cap growth bucket. We like the large cap growth bucket as well because we think it also includes some interesting tech names that can get some outperformance thanks to innovation, and healthcare names as well. You know, I don't mean to push a certain stock at you at all, but just as an example, Mead Johnson, I think is just a great story because here's a company that makes baby food, and American women are having fewer babies. So this should be a company in structural decline, and yet its company is doing not only well, but it's outperforming the S&P. Why? Well, it's innovating and coming up with new formulas and charging women more money for this superfood that will make your baby smart. But they're also selling to China, and China has had so many issues with milk products, but also has an aspirational middle class that they're willing to pony up for this high-end baby formula too. So this company's knocking it out of the park. And I just, again, it's just one example, but I think that there are an ample number of those sorts of firms that either through revenue sources overseas or innovation are going to be able to give you some outperformance even in a sideways stock market. We're also looking at emerging market equities, but very much from an actively managed point of view. You know, I get in fights all the time on CNBC with the stock pickers because I'll say, you know, China's soft landing, and they'll say, oh, but Chinese stocks stink. I'm like, look, growth and stock markets are not necessarily correlated. Brazil has great growth, but the Bovespa was horrible for the last year. You know, just buying an index based on a macro view is not going to make you money. But if you understand the companies and the sectors and the trends, I think you can get some outperformance. So I'd rather pay a slightly higher fee and have active management and stock picking rather than an index exposure in EM. But I do think, especially from a macro point of view, now that central banks in emerging markets are starting to ease policy, and we've seen some kind of administrative easing already in China, we've seen rate cuts in Brazil, we've seen rate cuts in Israel, in Indonesia, in Turkey. The trend's changing, and that at a margin is going to be positive for the EM equities. Fixed income, we're looking for yield. You know, if we're not going to get it from government bonds, and we think the U.S. 10-year holds very comfortably under 3%, at least for the next year, maybe longer, we need to find it somewhere else. And when you look at U.S. corporate balance sheets, you look at what's priced in for default risk, U.S. high-yield credit to us makes sense. EM debt makes sense. You know, I have here inflation-linked bonds. You might think, well, if you think the world's slowing, why do you need to care about inflation? I think you always care about inflation when you don't have inflation. You know, the time to make sure you have inflation protection in your portfolio is when it's cheap to buy. So we are looking at some real return strategies, including bonds with CPI swaps as part of our fixed income bucket. On alts, you know, one thing I heard a lot in Asia, and this is a special kind of client because sovereign wealth funds and central banks don't need liquidity to the same degree as others, but they're increasing their exposures to EM and to alts. And alts because they say volatility is going to stay high, I want the return, but I'm tired of the public market vol, so they're moving more into macro, into long short, but also into things like mezzanine, into real estate, into infrastructure, looking at special opportunities like distressed credit in Europe, and that's going into that bucket. You know, mezzanine is something that we've looked at quite a lot just because you are seeing shifts in the amount of capital available to companies from normal channels, especially banks. And that is another source of income and yield for a portfolio, right-sized in the portfolio, but there. And last but not least, we believe the structural decline in the dollar is continuing. Doesn't mean the dollar goes down against everything. I think the dollar probably is sideways against the yen, and Swiss franc, you know, you've got intervention going on there. But I think the dollar will keep going down against commodity-producing currencies like Australia, Canada, Brazil, Chile, and against some of the emerging Asian currencies, including the Chinese renminbi. We think the renminbi will rise against the dollar. Dollar renminbi will fall basically at the path it's been on, 4 or 5% a year. China pegged the currency during the crisis, but it didn't devalue the renminbi. It just stopped. That's, again, from an investor's point of view, I love that. If I can buy something that either moves or stops but doesn't go against me, that's good. Now, it's not that easy to get exposure to the renminbi. You have to use non-deliverable forwards, or you use the offshore market, which isn't terribly liquid yet. But I think you can buy regional short-duration emerging market bonds and have a decent proxy to that. So those are some of our key thoughts for next year for positioning.
Yeah, so if the, at least the medium-term prognosis for European public equities is not good, is there a reason why we shouldn't be downsizing them?
Well, we have, obviously with asset management, we have to have lots of different strategies for different client needs. Our private bank managed portfolio might actually be a better proxy for what you all are doing. We have $720 billion under management, and the clients are fairly risk averse, right? So and we're open architecture. So we interview tons of managers and do our due diligence. We have a fairly large underweight to Europe, the biggest underweight to European public equities we've ever had. That said, we haven't taken it to zero. We still have some exposure, and within that bucket, what we're trying to do primarily is the dividend play. You look at a company like France Telecom, you have a dividend yield right now of around 9%. And that is a carrier that actually does something. It provides a service, and it's a company that's likely to be supported by the French government. Doesn't mean the global beta can't throw it around all over the place and give you some volatility, but at least you get a pretty nice dividend yield to compensate for the vol. So we're trying to look for specific opportunities within European equities like that. But we do have a pretty large underweight.
Can I follow up? These are kind of two related questions. One, with the restructuring of the Greek debt, and I'm assuming we're talking about both sovereign and bank.
Well, sovereign is the one I'm focusing on.
Okay.
But
Well, let's focus
yes.
on that. If they're reluctant to restructure that, how is that going to play out? And the related question is, with Italy's sovereign debt at 120, isn't there a restructuring down the road for that also, and how is that going to play out?
Sure. So on the Greek restructuring, it isn't the Greeks so much that are unhappy about restructuring. It's mainly the Germans because they don't want to have to end up paying the bill directly or indirectly. The German voters are pushing against that. There's also an issue of who should bear the pain from this? Should it be the private bondholders? Should it be the ECB? Should it be the governments? Who foots the bill? And that's the debate kind of preventing them from taking bigger, faster steps. The other issue, which I think still gets some attention in the hedge fund community, is a write-down and a swap from your current debt to this new debt worth 50% going to be voluntary or not. And if it's perceived as not voluntary, it triggers credit default swaps. And then there's worry over the spillover risk from that. So there's a couple issues preventing it, but it's not the Greeks preventing it, really. I think the Greeks would be welcoming a quick and big restructuring of the debt, quite frankly. On the Italian debt, Italy's different because Italy doesn't have a big budget deficit. Greece has very high debt, but also a high budget deficit. Italy actually has a primary surplus, budget surplus. Small, but having that surplus has enabled them, along with slow growth, to keep the yields down enough to service the debt. But you have to have everything falling perfectly into place. The moment you either have slower growth or higher yields, it doesn't work anymore. I don't think Italy will have to restructure its debt, but I do think Mario Monti will have to get the politicians behind him so he has to get an austerity package passed to get IMF help to get the capital to push down the yield so Italy doesn't need to tap public markets for a while.
So in the short term, Italian debt, I think Italian sovereign might be a good bet.
It depends on your risk appetite.
Okay.
I'm not that brave in the short term.
Any further questions? Thanks very much.
Thank you so much for your time.
Thank you all very much. As you know, Rebecca provides these market insights to institutional clients to help you stay ahead, what to look for, especially in uncertain times. If anyone's interested in getting Rebecca's insights on a weekly basis, we've webcast a recent one on elections in 2012. Happy to collect emails, whether through Martin or Yvonne, to make sure everyone's getting Rebecca's future information.
I send out emails to clients when I have something to say. I don't try to spam people, but maybe once a week or every other week I'll send out a note. So if anyone wants to be on the list, please let us know.
Thank you so much.
Thank you.
Okay, thank you.
Okay, Eric, Peter, in 1 second. Bill, then Peter. So rather than do anything else, we just... Wait a minute.
Want to talk to Eric briefly about that?
Yeah.
Larry? So there is a procedural issue that I want to get your thoughts on. Larry will step back in. The board policy is that if there's a special request from a journalist, we require 3 days to think about it. The New York Post is here and would like to photograph the proceedings. So this is obviously in addition to the videotape that the Comptroller's Office streams live on its website. I don't particularly care. I have no objection. It's already public. Any thoughts from my fellow trustees? It will be distracting, but
Can he sit down, or is he going to be running around?
we can.
You can direct him. You can direct, I mean, the rule says that it cannot be disruptive of the meeting. So, and actually have 2 photographers. I don't just want to have 2 photographers.
The only issue I have with that is that if we do it for the post, we have to do it for everybody else going forward.
Right. So the question is, do we want to make a one-time exception? They have invoked the historic nature of this moment.
But you can't make a one-time exception. You got to do it all the time.
Well, what we would say is that, what we would say is that the rule requires a 3-day notice from them. And what they're saying is that because this was added to the agenda and they were not aware of the rule, which has been posted, that they would ask for this one-time exception. I will tell you, there are 2 photographers out there, not just one.
Well, I only have one request. I must be in the photo.
I just have one question.
Please, John.
If we were to say no, would the photographers have access to the feed that we're providing to the controller's office? They get screen captures and take the photos from their views.
Absolutely.
Now, I have to ask the
tech
people,
people.
the tech people, controller's office.
Tech people?
The general public does have access to the archived video, so they can grab the screenshots off.
Okay, would they be able to do it today?
It's available within 4 hours of the meeting.
Are they going to remain during the meeting, or
They're invited to stay during the public session.
No, they would be here through the whole public session. They wouldn't be going in and out. We would not allow
So we
that.
can give them a 2-minute window. We don't have to allow to take their photographs and then leave.
Okay.
All right.
So at the beginning of the presentation, we'll allow the reporters are all going to be here. They're all here. But we'll allow the photographers to come in for the first 2 minutes of the controller's presentation, and then we'll ask them to finish their pictures and leave.
Yes, we have significant business. They can take 2 minutes.
Okay.
Okay.
So with that, we'll inhale.
Everybody breathe in. How's my hair?
It really was. You like it. I'm very well. I think it's small.
Morning, Eric. Thank you for joining us.
Madam Chairman, thank you for having me.
A pleasure.
You want to repeat First Deputy Controller?
Some of the faces I recognize. Would you mind, Madam Chair, if we could just briefly have people introduce themselves?
Be our
just so I know?
pleasure. Why don't we start with Martin to your right?
That's an easy one. Thanks.
First, I want to start with Martin.
Hi, Seema.
Inga Van Eisen, Law Department.
Hugh Weinberg, Queensboro President's Office.
Howard Rodriguez, Borough President's Office.
Jason Othaniel, Brooklyn Borough President's Office.
John Zacconi, Staten Island Borough President.
Jackie Sherman, Public Advocate's Office.
Jen
Morning, Jackie.
Sudbury, Mayor's Office of Pensions and Investments.
Morning.
Franji Nagaswamy.
Diane D'Alessandro, Executive Director.
Morning.
Morning.
Oliver Gray, DC 37.
Morning, sir.
Larry Perry, General Counsel to the local 100.
Morning, Larry.
Gregory Floyd, International Brotherhood of Teamsters.
Mr. President, good morning.
Jimmy Yan, Manhattan Borough President's Office.
North Actuary, Mark Ryan, Callan Associates.
Valerie.
Good morning, Valerie. Well, thank you.
Court reporter.
I'm sorry. I'm sorry.
Court reporter.
And good morning, court reporter. Well, first of all, good morning to all of you, and thank you for the opportunity to come and speak in greater detail about the proposal. If I could, let me just quickly summarize the proposal. I know you have some questions, and I should probably go through your questions, and then you'll probably have more questions after that, and I can, Madam Chair, based upon the time of the agenda, you tell me when to stop, and I'll stop.
We will stop when the questions stop, and just to clarify, the photographers have just about a minute to take their last pictures, and then so we're not distracting you.
Okay.
Is there one photographer or two?
The other photographer left and is on his way back, so when he comes back, we'll let him come in for a minute and take shots.
Keep going, Eric.
So about it was 12 business days ago now, a number of municipal labor leaders, the mayor and the controller, announced an agreement in principle, and I underscore that because it was simply that, an agreement in principle. And the core of the agreement sought to do four things, right? All very straightforward. We're debating here, even at this table, amongst different constituents, what the cost, what the drivers of rising pension costs are, but there's no debate that pension costs are rising. So job one was to figure out, over long term, how do you lower those, the costs of public employee pensions. Two was, in the process, how do you lessen taxpayer burden. Three, in lowering those costs and lessening taxpayer burden, how do you protect and strengthen? The current and future pension benefits of what everyone agrees are world-class public employees. Fourth, in doing so, how do you reduce the risk? And the words here are selected carefully and thoughtfully. How do you reduce the risk of fraud, waste, corruption, abuse going forward? And last but not least, in the world's financial capital, how do you build a world-class asset management organization for years to come? With that frame in mind, a number of us a few weeks ago began thinking about sort of what does this organization look like, and began just actively listening. Now, some of you at this table probably didn't realize what I was listening for when I was asking you questions on what works and what doesn't work, but in the back of my mind, the charge was to think through how to build this world-class organization. And so we looked at a number of models globally. And when you think of global public pension models, you see clearly that in many instances the Canadians have done it best, right, amongst a number of peers. And we looked at two buckets, the governance and management of those best-in-class models. And we also looked at how their models performed over time, because doing it just for the sake of doing it doesn't make any sense. There has to be some material benefit to New York City taxpayers and public employees at the end of the day. It shouldn't just be an academic exercise. So that is where the crafting of the initial agreement in principle came from. And the agreement is fairly straightforward. I won't go through everything that was in the press release. It's all on the website, and you all have no doubt read the materials, which are the driver for the questions. The agreement simply is the 5 existing boards, which have 3 functions across the 5, right? So my references here will not be to NYCERS necessarily in particular, unless you ask me a question just about NYCERS. I'm talking about the retirement system as a whole. But across the 5, they have 3 functions: benefits administration, disability determination, and asset management. So the agreement in principle says that those 5 should delegate authority to a new entity. Some have called it a board, some have called it a committee, a group. You know, someone's more intelligent will figure out the name, but they delegate the authority to manage those assets to a new pension advisory board, pension investment board, which is what we referred to it as. 1, 2, that entity in turn assumes the oversight over what is currently the Bureau of Asset Management. So the second phase here is that the controller or any elected official is removed from that internal layer, because as you know, right now, annually you designate the controller as your investment advisors. The TRS board does it quarterly, and you all have done this for the better part of a number of decades now. So instead of designating him, you'd be designating this new board, new committee, and he would be removed from the process. So we talk about depoliticizing. That's the depolitization that we're talking about, removing an elected official from that layer of oversight. The third key component here is that the CIO and that new entity would be reporting directly to that new board or committee, which is again, there are no new ideas here. Everything I've said has been taken from a model cast somewhere else around the U.S. or around the globe. And last but not least, we would work in principle, the head of that entity, call it Bureau of Asset Management or NUBAM, some people have called it. I think we called it the IMC. The name's not as important. But what that new entity would do was over time develop its professional staff, all public employees, and a lot of myths here about outsourcing the whole function to Wall Street. These folks have been public employees for the last 70 years. God willing, they'll be public employees for the next 70 years. So the Bureau of Asset Management stays public employees, but our public employees should be able to manage assets as well as anyone else at any other public pension fund around the world. So the fourth component of this is insourcing effectively what has been outsourced to some of your 362 various asset managers or 15 consultants over the last 70 years or so. And so those are the 4 basic components, if you will, of the proposal. Again, no new ideas. All things that have been gleaned from other models around the globe. And again, the goal here is for the world's financial capital to have a best-in-class global model. Madam Chair.
I'm going to ask the photographers to please excuse us. We need to carry on with our business. Thank you very much. Continue, Eric. Sorry.
So you have a number of questions here. Looking at your faces, you have more questions in front of you. Let me just go through the questions that Mr. Carey and others have been kind enough to craft. I have some questions for you as well, and this will be the obviously the start, not the end of not the end of a dialogue. I'm just going here. The proposed structure of the new investment board includes details about qualifications of prospective board members, the process for being appointed to the board, and the processes for removing members from the board, if any. So that was question number one. There are 3 or 4 principles, Larry, that have come out of discussions with a number of folks in labor and elected officials as it relates to this new board or new committee. Principle number 1 is that it took 71 years to create. It's going to take more than 12 days to fix or to come up with a new idea. But there's an agreement in principle that we can do better than the current structure. Principle number 2 is that labor must have 50%, whatever the representation is. So, I mean, whatever the table is, there must be labor on half and elected officials on half. And so that's been clear in terms of the input from labor. And that also tags with best-in-class models globally. Another bit of feedback from labor, I had suggested earlier on that that we look to certain models, but labor has also said, for the labor representatives on our side of the table, they must be members. Eric, we love you, but we're not interested in having you represent this union, right? They must be our members representing us. And last but not least, there's been a lot of discussion about the 12 and who's going to pick the 12 and how are they picked. Yeah, and I've heard a bunch of anyway, just interesting chatter. The number 12 was clearly from my head and my research. When you look at the best-in-class models, the number is somewhere between 7 and 15. I picked 12 because that's, it just made sense. But I would posit to you today the number is probably somewhere between 1, which is a sole trustee, and 58, which is what we have right now. So there's a lot of room for growth, and all of you have ideas on what that number should be and what those representatives. So actually, a number of people have started to actually send ideas. They should be done by weight, should be done by number of members, it should be done by retirees, whatever the case may be. So we're actively listening now to people to get to the right number. There is no perfect number, but again, what I've said publicly, privately, and now publicly, as you have media present here, I believe, is the number should probably be somewhere between 1 and 58. I had been talking about 12. Others have talked about 12, just because I picked something, the number between roughly between 7 and 15. There was no magic to it. Another question you had, Larry, was about the qualifications. There is so much, and I encourage all of you, to the extent you have the time, we posted a bibliography online, a lot of discussions about what the qualifications for these board members, the committee members should be. I think the place where there's only initial consensus right now, or growing consensus, right, is that board members should both have passion about those that they represent. On one side of the table, taxpayers; on the other side, public employees. So they should be passionate about their representation, right? And they should also be knowledgeable about how to set strategy and direction and make decisions around $120 billion. So I think that's, in terms of qualifications, that's one. Again, a lot of reading, a lot of writing and research on there at this topic. But the other place that there's growing consensus is that there should be some kind of annual assessment, or biannual. You pick the period of time, but there should be some sort of ongoing assessment, so we can honestly take 12 months, look at this, step back, and say, Well, SEMA is strong in this area. President Floyd is strong in this area. But there's something that we lack, for the next 3 to 5 years. Let's all agree that the next trustees coming on and next members coming on this committee should have stronger, areas of focus or background or expertise. And so the self-assessment, and I know that sounds relatively simple thing. Some of your boards do that on an annual basis. Some boards do not engage in this self-assessment process. But the only other key item that has come up on the qualification front is a willingness to take a board and a self-assessment on an ongoing basis to figure out sort of what are the skill sets that we need going forward. Number 2 was the process for formulating the investment policies for the new investment board. As you know.
Actually, Eric, you can mind just which is the question. So, from what I'm hearing you describe, you kind of headed in a direction where the union representatives on the board would be union members, but then there'd be these other qualifications that will apply to them?
No, the qualifications should apply to everyone, right? You should have passion and you should have knowledge, and that's, again, you can drive, that's a mile wide. And when you do the research, some of the research says, well, the board should be all labor representatives. Some research says it should be all financial professionals. We're never going to get there. And so that's got to be, as all of you nod your heads agreeingly. And so there's no perfect model, but that's the current thinking.
Okay, there's a follow-up. And so at the initial formation of the board and going forward, if there are these qualifications, who's going to decide whether the proposed members are meeting the qualifications?
Well, it would be that board. It would be that entity.
Initially? Well, initially, I mean, you're going to appoint people initially, so there won't be a board here.
Right, and because I'm not making the appointments, you all will be making the appointment. They're going to be representing the NYCERS board, so you're going to decide who's going to, represent, going to represent you. And the other thing that I'd add is that there are a number of ways when you look at these models. CPP is the one I'm referring to, the Canadian Pension Plan. They don't necessarily change members or the makeup of the personnel. They provide educational, opportunities during the course of the year to say, here's a big issue on the horizon, or here's something that we view, a year or 3 years down the line. Let's have all the board spend 2 days, 3 days diving deep on this respective issue. That's another way to address the self-assessment or the board assessment issue. So there are 10 ways to get there. I mentioned, 2, looking at the makeup of the board, or providing educational opportunities in the interim to make sure that on the knowledge base that there's alignment.
John and then Larry.
Forgive me, you just said something that I found somewhat confusing based on what you said before. NYCERS is going to appoint somebody to this committee or board? Because you said NYCERS will decide the qualifications of the person they send. Is that the case?
Well, I said that the representatives to the new committee are going to be representatives of the five boards, right? So you're going to have
So we're a board sitting here now, and we'll decide who we send to the committee?
Correct. In theory, that's absolutely an option.
Okay, because that's somewhat different than was put in the press conference.
Well, I don't know that.
Well, I think Eric is just listing several ways of getting there, right? You're not prescribing something, you're just saying there are lots of different ways.
And you're going to have more ideas, and I've got a bunch of ideas, and so that's
All right. So what you're saying is that the appointment process hasn't been.
No. Yeah, I mean, there is no secret list. I don't have the 12 people. I've heard more rumors about the things that have been promised to me over the next. Just don't believe what you hear. There is no magical board. There is no magical membership. There is no It just doesn't, and it just doesn't exist. Larry?
Yeah. I actually have to express some reservations about one of your underlying assumptions associated with the creation of this new entity, as you've outlined it. I think it's a great idea that it would be 50-50 in terms of public sector representatives and union representatives. But when you attempt to paint the picture that people on this board would have to have qualifications beyond the fact that they were put on that board by their respective constituencies, I have some real reservations about that. Number one, I don't like the idea that the other side of the board would have a say-so about who's on the other side of the board, in all candor, because that's not independence. Number two, and this is not to denigrate anybody in the labor movement, but there are many, many, many working people who are in this plan who won't have a clue about how this fund operates or how any of these funds operate.
And that's the case today.
And, well, but you know something? The way we deal with it is we have educationals for everybody on the board, as you just saw.
Right.
Right? And so we bring people up to speed to the degree we can. But the idea that there should be some test or testable expertise that should be required of people to be on the board, I find very objectionable. And I have to just let you know, I am not a member of this pension plan. I happen to be general counsel to TWU Local 100, and I happen to have spent the last 25 years of my life as an attorney sitting in pension meetings, but I'm not a member of this thing. And if you're talking about requiring people to be members, that also raises certain issues in terms of limiting the ability of the unions to appoint people that they feel comfortable with.
All fair points. Point taken.
Appreciate it.
Sure.
Rick?
I'm confused. I'm confused because you spoke for about 20 minutes, and I don't know any more than I knew before you started speaking.
And we spoke for an hour and a half 2 weeks ago, so there's an hour and 50 minutes of discussion. So,
Now,
but please.
Let me just say, I think it was in June, there was a presentation made by the controller that the pension funds were sound, and we got a 20% return, and things were good, things were rosy. And only a few short months, I hear the sky is falling, and the pension funds need to be restructured, and we need to make these drastic changes to the boards, and the boards that we had were inefficient to operate the pension funds. So either the report then was wrong, or this report is wrong. I'm just trying to figure out which one am I going to believe.
Sure. So the sky is not falling. I guarantee you that. I promise you all, the sky is not falling. One, two, I promise you that in the last fiscal year, these five funds beat the pants off your competitors globally. So I don't know when that number is going to be audited in public, Mr. Schloss, but you'll see that you had a great last fiscal year. But as Mr. North will tell you, you had a very challenging first quarter. And so the nothing that we have discussed over the course of the last few weeks, this is not about fiscal year 12 or fiscal year 13. This is about looking 10, 20, 30 years into the future and trying to build a model to really differentiate us from peers in the world's financial capital, A, and B, lessen taxpayer burden while protecting current and future public employee benefits. So yes, it's correct. You had a great year last year. Everyone around the globe has had a challenging last 3 months of the first fiscal quarter. But this is not about, don't think of this as about next year or the following year. These things are really looking well into the future and trying to build that, in terms of trying to build that model.
Please. Well, again, I'm going to come back and ask something about the assumptions that you articulated. From the published reports, and from what you're saying, there seems to be a vision that somehow this change will automatically result in greater returns on our investments. And we haven't gotten to that section yet, but I'd like to understand how it is that such a prediction of future return is being made.
Right.
Can be made.
Right.
If we were regulated by the SEC, there'd be an investigation going on right now of that future prediction.
Right.
So,
We're
not, so there won't
right.
be. But it's a very serious issue to tell the public that you're going to get 1 or 2% greater returns as a result of making a change.
Right. And we all have to choose our words very, very carefully. So I said assessment, you said test, right? I never used the word test. 1, 2, no one has ever said, and no one could ever say that this ensures anything. There are no guarantees, and 2, automatic. So I'm just using your words. That's never anything you've heard from anyone who has spoken about this that I know of. The 1 to 2% goes to, again, it's all on the website. There are many, many pages of reading. And let me tell you what the basis for Keith Ambachir's statement. Keith is one of 10 or so experts in the area that we have talked to. Jim Leach, I think, who is hands down cited as one of the best public pension fund CIOs in the globe, the head of Ontario Teachers, and I think he's also spoken to this. By the way, our 10-year number system-wide is 2.5. Jim Leach's is about 6.6%. Bunch of reasons for that, but he will tell you that these best-in-class governance and management changes help you get there. But again, no assurances, no guarantees. No one in their right mind can provide that to any of you. There are 5 variables that all of the research speaks to that underline that 1 to 2%. Some of the research even talks about 3% differential, but just to the 100 to 200 basis points. The 5 variables are clear accountability and authority. So let's just stick with that for a second. When you have 5 boards, 58 trustees with 66 votes, 15 consultants, 362 asset managers, and 82 staff on BAM, it is tough to tell who's accountable, who has accountability and authority when you're looking at our performance over any 10, 20, or 30-year period of time. So the new governance and management model over time would inject a level of clear accountability and authority. The second differential is long-term investment initiative and direction, which is why when you look at the best-in-class models, it's important to depoliticize by removing that elected official. I've worked for Control Lou for 2 years, and God willing, I'll be there for another 2 years. But the commitment can be no longer than a 4-year period of time, right? Well, when you ask CIOs and controllers and first deputies over the course of the last 40 years, they'll say it's tough to function looking at 10, 20, 30-year investment or economic cycles when you've got to think every 4 years. Actually, you don't even have 4 years to think about from one election to the next. You've got to think really in 2-year increments. I'm 2 years into my term. Now I've got to think about the next 2 years going forward. And so having a CIO independent of any elected official, mayor, controller, whoever she or he may be, right, having a CIO and a BAM independent reporting directly to that board allows, and by the way, the average term of service for those best-in-class CIOs is 14 to 16 years, right? So it's tough to have anyone leading this staff in four-year increments that can really look long-term. So long-term investment alignment. The third differentiator between our current model and the aspirational model is a real risk management organization. Larry, others will tell you it has been tough to attract top-tier risk management staff to this office, and others will tell you that this has been the case in prior years because it takes a long time to develop these models and to monitor these models and to build this type of team. And people, in fact, want to make we'd have a difference of opinion. I'm not of the belief that it is all about compensation. I think equally important for professionals, it's about working in a depoliticized organization where there is a long-term commitment to my growth and development in my career. Yes, compensation is important, but I think that long-term commitment is in the risk management function and building a real risk management organization. That's a big differentiator. The fourth variable in that 1 to 2%, Keith Ambachur, Dr. Eng, another number of folks will tell you, is having first mover advantage. And I would posit to you that the current system in New York City has what I call last mover disadvantage, because you have a process that has developed over the last 70 years that is so burdensome and so laden with any number of challenges. If this building went on sale today, right, I'm blocks from my home now, and just blocks from many of your offices. There would be a number of pension funds around the globe who would want to buy this building. They're the only entities with assets large enough along the institutional investor rung to be able to acquire this building. Your fund would be amongst the last to buy the building that you are in because you can't move quickly enough to make a decision. And it's not because they're, I've said this over and over and over again, it's not because there are bad people in place. People have been asked to do what they've been asked to do over the years. It's because the five funds don't have first mover advantage. Even if you might decide, well, I don't want to buy the building because I live here and work here and I know all the problems, I know all the warts on the building. But even if you wanted to, you wouldn't be. A lot of discussion around infrastructure. A number of trustees have come and said, can you figure out this infrastructure thing? If I wanted to invest in infrastructure a mile away from here, I probably couldn't do it. I'd probably end up having to take some degree of your capital and then going to an entity, probably in Canada, and say, would you help me figure out how to invest in something that's a mile away? And so you don't have first mover advantage, which is the fourth variable. You have what I call last mover disadvantage. Last but not least, an expert and professional staff. Again, I want to keep saying this. The Bureau of Asset Management has been, and in my point of view, should continue to be public employees for the last 70 and for the next 70 years. That being said, we should have the best asset management staff in the world's financial capital. We should be beating the pants off of every other fund, and people should be looking to the City of New York and that Bureau of Asset Management, its expertise, its professionalism, as opposed to us struggling to find best-in-class models globally. In 5 years, the hope is that we have an expert and professional staff. Again, great people, a number of whom are here. We have a phenomenal staff, but they've been working in a structure and in processes that don't make them a best-in-class global asset management organization.
Jason and then Jackie?
Just in regards to the issue of first mover advantage, is that more of a function or a result of city PPB rules?
A great question. Tell me your name again.
Sorry?
Tell me your name again.
Jason O'Donoghue.
Jason, but it's a number of things, right? Larry knows I enjoy drawing, right? I can't draw here. So it's a few things, right? So each of you have consultants, right? Each board has its own set of consultants, and as I'm told, those pools of consultants have developed over the last 40 years because there was a level of trust or mistrust about the competence of the asset management staff, and are they really up to making these decisions? All right, well, let's go hire a consultant, and now I see this board has a general consultant. Well, I need one. This one has a private equity consultant. I need one, and you know, these guys have a real estate consultant. So the consultants have developed over time. So that's one level, right? I'm not ordering these. So you have a series of consultants that you have to go through to get to a decision. 1, 2, absolutely. You have PPB rules, you've got MOX rules, you've got me standing in the way, you've got the New York City Comptroller's Office, and so layers and layers of rules and regulations have been developed over the years. What do you also have? You've got 5 boards, right? You have 5 boards, so in order to make a system-wide decision, you have to do what? You have to go to each one of the 5 boards over the course of a month or a quarter to get a decision, and all of those things, right? In PPB, you're absolutely right, and you've been talking about these issues, and you've made progress in this respect. But you know, the RFP process alone adds months. But it's all those things, Jason. It's not just one in particular that add to the timing. And not to mention the fact that I don't know that you currently have the personnel that you need to make faster decisions. You know, there's no one that you can turn to in the Bureau of Asset Management to say, do due diligence on this bridge to figure out whether or not, you know, we can go in. And again, they're good people, right, but they've not been asked to. So what are you going to have to do? You're going to have to go out, hire a consultant, or, you know, hire some outside, you know, party because you lack the in-house personnel to move swiftly to make a decision. So you'd have to add to that 362 or add to the 15, and that, mind you, is going to take you 12 months before you even start looking at an investment.
I want to come back to the layers of rules and regulations in a sec.
Just want to grab the water. Is there one? Thank you.
First, I just wanted to thank you for making today's presentation and say that we do look forward to being part of this conversation as it unfolds. And that there are several underlying principles here to commend in the proposal as it's been described thus far. The basic premise of increasing the efficiency of investments and streamlining the investment process, opening up new investment opportunities, and the drive to insulate the work of the pension systems from political influence, fraud, waste, and abuse. At the same time, we have concerns thus far about the details of the proposal, and your expanding on them here helps, and as I said, we'll look forward to hearing more in the future. In particular, we have some concerns about fairness and representation in the governance structure as we've heard about it thus far, and as well as transparency and accountability in the proposed investment office.
Absolutely.
And this comes back around to the layers of rules and regulations. And I'm interested in hearing, based on your extensive research, how have other jurisdictions that have implemented similar reforms addressed the issue of transparency and accountability? Based on the research, what are the best practices? And then a specific question, New York focused, would these new entities be subject to regulations like FOIL and the Open Meetings Law?
Jackie, right? Okay. So I'm not an attorney, but a bunch of attorneys much smarter than I will address the details of much of what, FOIL, access and the like. You don't get to the fourth principle that we talked about earlier creating an environment where the risk of fraud, waste, and abuse is reduced without a very open, transparent, and accountable set of processes and policies. You can't have one without the other. So you hit the nail on the head. You have to have both, right? And so a number of nonprofit organizations are actually sending us ideas on here is what best-in-class models look like in terms of openness and transparency. And I'm spending as much time as I can actively listening to those ideas. But it must, the need for openness and transparency must be an underlying principle here, because you can't have, something that's closed and unaccountable and still have, still hope to address the overlying principle of reducing the risk of waste and abuse. And so but do I have the answer to the question of loyal access or no? I mean, if you put a gun to my head, I'd say yes, probably so, but a number of attorneys here don't climb over the table. I'm not an attorney. We'll ask a bunch of smart attorneys to think through, exactly, access to documents, access to meetings, and the like. But to your macro point, yes, it must. We have failed if we have not created a best-in-class, open, accountable, and transparent model going forward. So that has to be part of the equation.
Larry, and then Al.
Well, I think we are in agreement. We want open and we want transparent process here. But I happen to think that having 5 boards is not a detriment to having transparency. I think, in fact, it helps transparency. An investment decision that has to be put to 5 independent boards, that has to be looked at seriously 5 times, is not a decision that is made in a small room. It's a decision that's made with a lot of thought and with a lot of people being involved in that decision. Now, I don't see the need to go through 5 boards as being such a difficult problem, because the decision of this board about going into an investment is this board's decision. The decision of the Fireman's Fund to go into an investment is their decision. There's no obligation that we buy the same products that they buy and vice versa. But there is a difference between this board and some of the other boards, and that is our long-term performance is much better than some of the other pension funds. If you look at our funding ratio, it is better than some of the other funds, and that's not to denigrate anybody. It's a very difficult business to try to make money in the stock market. People get paid millions of dollars on the theory that they know how to do it. But the fact of the matter is that this is the board that has 5 borough presidents. This is the board that has the public advocate's office. This is the board that has, between the 3 unions, a couple of 100,000 employees represented on this board. And this board has a better funding ratio than the rest. And so we have more openness, more transparency. I'm unaware, I've been sitting here for 2 years, if somebody knows of any corruption involved in the process over the last 2 years, I'd say put it on the table. I don't know of any, or political overreaching. I don't know of any such event. In fact, what I do know is that with very rare exception, every single recommendation that Dan has brought to this table has been accepted by the board. The recommendations to hire particular managers, the recommendations to have asset allocation policies, the recommendation to, in fact, over my objection to eliminate the RFP process, which I think is a very important thing for a public fund. But I'm a minority on the board on that question, and we're having an experiment for the year. Right? So from an empirical point of view, from where I sit, this is the most transparent, open board. Yet, as I understand the original proposal, 2/3 of the unions were not going to be included in the vote in terms of the new structure. That's only my understanding at the time. You're going to eliminate the borough presidents and eliminate the public advocate from the new structure. That's only my understanding as it was proposed. And I don't see how that's conducive to transparency. I don't see how that's conducive to accountability. I don't see it as conducive to good investment policy, quite honestly. The needs of this fund are different from the needs of the teachers' fund. They are overwhelmingly female, if you look, and I have the reports here. They live a lot longer than men do. Some of the other funds retire at an earlier age than what our members retire at, consistently. The funding needs are different, the demographics are different, our funding ratios are different. So this concept that we're going to put one size fits all into a committee which is not going to have RFP, right, as I understand it. We're not going to have a public process because that would slow things down. The goal is to eliminate and get it down to 3 or 4 months in terms of making a decision from we want to invest in something and going to it. I think it's highly suspect. You know, I'm a great advocate. Larry sat here, and I've said to him, I support the idea of paying qualified people more than probably what they're making. I think Larry's severely underpaid. But when the comparison...
I completely disagree. I completely, as a taxpayer, I completely disagree.
And just for purposes of consistency, I think our chairwoman is severely underpaid.
That I agree to.
And I'm sure you are, too. But, you know, the comparison that somehow we're going to go to performance along the lines of the Harvard or the Yale endowment is a fantasy. Number one, and let me just finish my point.
Okay,
it's a fantasy, and that's the comparison that was put in the newspapers for the public to hear. I mean, if you read the Yale endowment report, and our chairwoman is on the Yale endowment, so I'm not saying anything that she's unaware of. They measure their investment horizon in centuries, which is a remarkable concept. All right? We do not. We have to pay a pension benefit this month to a large number of people. We can't sit here and wait centuries for the returns to be able to justify or enable us to pay those benefits. We pay more in benefits than what the city gives us every year. We have to get return from our investments because the employer doesn't pay the cost of what it costs today to provide these benefits. And the amount of money we pay far exceeds as a percentage of our assets what Harvard or Yale devotes to supporting those very fine institutions. Now, the head of the Harvard endowment made $4.5 million last year. The head of the Yale endowment made a little less, just under $4 million. Right? The concept of getting the best people and paying market, are we talking about paying somebody $4 million a year to run these funds?
I don't think so. At least that's, I think that's politically untenable. So there's a lot of space between the $224,000 that Larry makes today and the $4 million that someone at Harvard and Harvard and Yale are very small, as you know. So it's not accurate, with all due respect to the mayor and the controller. I don't know that it's necessarily accurate to compare a $120 billion public pension fund with hundreds of thousands of members and hundreds of thousands of retirees to, you know, Harvard and to your point. So I agree that I don't know if Harvard and Yale are, but prior to you mentioning them, you'll note that I did not say Harvard or Yale. I think what you want to do is look at, you know, $50 billion plus public pension funds with underlying municipal employees as the. I think those are the right models to look to. And you made a number of other points. Points taken, Larry. That's all I can say at this point.
Yeah, I just want to cover the points you made with the 5 points you made with respect to best practices.
Right.
And some of what I'll say will repeat what Larry has just said, but maybe in a slightly different way. Number one, with respect to professional staff, this board, for quite a while right now, has been urging the controller and let the controller know that we support professionalizing the staff to the greatest extent possible. And that means hiring more people, paying people better, because we believe at the end of the day, it will result, that kind of thing will result in better performance by the department.
They're all sitting behind you, nodding their
Yes.
heads. So
Yes,
you
know that.
you
But
got to agree. But I hear you.
It's
I hear
been a
you.
consensus on this board
Fair
for
point.
a long time now that should happen.
Point taken.
Okay? Second thing, in terms of the first mover, this board for a long time has been very fed up with the procurement policy board rules and their applications to the operations of this board. We believe they shouldn't apply. We've made some movements in that direction recently at Larry's that has been leadership, which this board approved, which is experimenting without using the RFP process. Okay? This board has okayed that. Recently, we created a alternative investment program where we've been moving very rapidly in making investments in distressed debt opportunities and other opportunities. This board has reacted very well to the suggestions that have been made by Larry. With respect to risk management, Ranji has been beating the risk management on this board since she showed up here. She has put everybody on the board into submission into her goal. This board is ready to do that. This board is ready to pay people to come onto the staff to create a real risk management operation at FAM. Number four, with respect to removing elected officials so that you don't have any politicization in the process. Somebody has to tell me where the process has been politicized to begin with, because I haven't seen it. And I've been on this board for 4.5 years. This board has not been making political decisions. Okay? This board has only been making decisions based on its fiduciary obligations, which are statutory, moral, and how we all understand what our fiduciary obligations are on this board, and I believe in good faith everybody in this board has been following those and not making investments based on political decisions. Anybody saying that this board has been operating that way, I want somebody to tell me where we've been doing it. Okay? Give $120 million to a board that has 12 people on it, that has a CIO that's making all the investment decisions. That's a real danger of having political influence. And all you have to do is read the papers for the last couple of years where big boards, where have lots of money, have problems, we're not accountable to any political party, we have real serious problems with political corruption, and I'll say it right out, calculus. Okay? Second, your last point, we were talking about having a situation where there's clear accountability and direction. Well, the board that's been proposed, I have a real problem. Because this board and the CIO will not be accountable to anybody once they're put in place. They won't be accountable to the participants in the funds. They won't be accountable to any of the people who are running the funds. They won't be accountable to the voters. They won't be accountable to elected officials. They won't be accountable to anybody. We won't be able to fire people if the CIO goes off the tracks or if the board goes off the tracks. None of the people at this table can get rid of them because they won't be accountable to any of us. So, at the end of the day, what I would say two things. There's some things that are bothering people about the board with respect to these 5 points. The other thing I would say, you don't need to create a new board to get to a place that you're talking about. We can professionalize the staff. We can have first mover advantage. We can have a real risk management operation. And there's no political influence here without creating this new board. It's all right there. All we have to do is do it. You don't need a new board to do any of these things.
Greg?
Yeah. I want to know, why is the controller advocating to give away one of his main responsibilities that he was elected by the people of New York City to perform? It's my opinion that he doesn't have the authority to give away part of his office without the voters. The voters voted for this controller and the controllers before him to be the custodian of the pension funds.
So, and this is an important point, so let's spend a minute on this. As you know, Greg, I am the son of an elected official. I'm from Buffalo. Doesn't make me a bad guy, I just am from Buffalo. I'm not from the city. Right? And so my father served in the state legislature for 36 years. And it is extremely rare to see any elected official ever to say, I will take a step back. I will support a concept that lessens my authority if it can do those four things: reduce costs, lessen taxpayer benefit, lessen taxpayer burden, protect public employee pension benefits, and reduce the risk of fraud, waste, or abuse. And so it is that this level of political courage is almost unheard of, because you don't see it. And so a number of people said, did I hear correctly that here's an individual willing to say that I support this agreement in principle? Yes, that is exactly what he has said. And he does not say it lightly. It has followed weeks of spirited discussion with him, and also him reading the same research that I've talked to all of you about, which says removal of that political layer, depoliticizing, Al. So when I said depoliticizing, I was referring to myself in the controller's office. Depoliticizing. So right now, Larry, Ricardo, and myself, we serve at the pleasure of the New York City Controller. Tomorrow, for reasons unbeknownst to any of you, he can say, it is time for you to move on. And what he believes is that when you're talking about investing for 10, 20, 30 years, that he should not be picking that person, because when you look over the last 40 years, Larry's predecessor had a different point of view than he does. And she had a different point of view than her predecessor. And he had a different point of view than his predecessor. So you can look at 40 years of investment decisions which have been made on 4 or 8 year cycles, not along 2, 10, 20. Again, not bad people, just bad processes. Not bad people, just bad process, because they've existed in a political at-will environment. So, yes, it is remarkable that he or any elected official is willing to say, in order to accomplish these things, if I have to step back, yes, I'd still like a seat on the board. Yes, I'd still, as the city's chief financial officer, very much like to stay involved. I have some value to add. But if it is for the greater good, I'm willing to agree in principle that this should happen. Some misunderstanding about the role of the office. The custodial role that the controller has, which is bestowed upon him, correct me, counsel, where I'm wrong, which is bestowed upon him by charter, that will remain. So every night we have a group of accountants that look at your 1,700 accounts, and they reconcile and say, all right, across the 5 funds, here are the accounts, boom, 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 here's the number. So the controller by charter is the custodian of those accounts. He will remain the custodian of those accounts. But what he's suggesting, what he's agreed to in principle, that the depolitization should take place in removing him going forward, primarily in selecting the CIO, because, as I said earlier, the best CIOs have served on average of 14, 16 years. You'll be hard-pressed to look in the city of New York any point in time over the last 70 years and find anybody who's been there for more than 10. And you have to take on these roles looking very much longer term than we have in the past.
Greg, did you have a follow-up?
Yes, I did. Al Rodriguez so eloquently outlined a whole process that can accomplish everything we laid out without dismantling our system, is what we have in place now. Right? And we've been advocating that for years, before Controller Group came around. And I would like to have sort of that process played out in a meeting rather than played out in public. And we certainly could have come to a meeting of the minds and figure out what the bottom line is, and we'd like to meet that bottom line. I always tell someone there are a number of ways to get to 7. You had 1 and 6, 6 and 1, 3 and 4. Bottom line is you want to get to 7. How we get there, we may not want to go that route. I can tell you I don't. Right now, I think we have a system in place that works. Can we improve on it? Yes. And I think we should consider what Al is saying, meeting the procurement process, meeting the BAM and the corpus funding and staffing and everything that we laid out, and come up with a number of compensation that will be acceptable and move forward with a process without dragging this political fight out in public. Because I think ultimately we're here for the taxpayers and also the pensioners.
Absolutely.
Because what Larry said is important. Each board is separate. That's why we have different pension funds. The teachers are separate. Their needs are separate. The fire department, their terms of service is different. They have a 20-year pension, 25, 22, wherever the number's going to be. They're going to live maybe a longer period of time. They're going to require a longer pension payout than what we have in this board. And the fact that we have the largest pension fund right here, and we have 4 of the 7 votes that didn't know about these discussions. That's, if I'm wrong, somebody correct me, that's the majority of the board that wasn't notified before these discussions took place.
So the accountability for the outreach, and I've said this to you privately, so I will say this to you publicly. I am singularly accountable for the outreach done prior to the announcement. So to the extent that there are issues with that, I apologize. As my older brother tells me often, charge it to my head, not to my heart, right? There was no malicious intent by not reaching out to it. And I hope you understand and receive that in the spirits in which it's made. And again, I'm not a great politician, nor will I ever be, right? But I do understand the goal here is to do 4 things. Increase the pension costs, lessen taxpayer burden, protect and ensure the current and future benefit of all public employees, reduce fraud, waste, and abuse in the process, and build a world, in the world's financial capital, build a world-class asset management organization. I'll also agree with you, Al. There are a bunch of ways to get there, right? And so these ideas are there. So to the extent you have ideas, this is a starting point, not an end point, and so we want to engage in that discussion. Yes, apologies to those who were left out of the discussion, and I'm looking forward to discussions like this and similar discussions over the last couple of weeks and the next couple of weeks. The intent here, folks, is to do the right thing for public employees, for taxpayers, and for the city of New York.
John and then Jason.
Yeah, just this quick statement, Eric. I've had some extensive discussions with the borough president over this proposal, and he has an open mind and asked me to express that, and he'd like to be, continue in the process to see where this comes out, where it ends up.
Thank you.
Most importantly, though, he wants to be in the process. Okay. 2 weeks have gone by. Nobody from your office has called my office that I know of. Nobody from your office has called me that I know of to discuss the issues that are here. We ask that in the future, as a member of this board, for myself and for every other member of the board, that we be included in the process. We may join with you. We may object to certain issues. We may come to some conciliatory measures. But if we don't know about it, we can never take your side. If you don't know about it, we can never agree, or we can never get to a resolution. Finding out about it by reading it in the Post, the News, the Times, and the Staten Island Advance is not helpful to your cause. And it's not helpful to the people who serve on the board. It's not helpful to the members who have to be paid their pension benefits by the board. And it's not helpful to the city that has to come up with the money to pay those benefits. So please, include us in the process.
Point taken.
And to dovetail off that, it also flies in the face of the fiduciary duty of the controller to partake in these discussions without his fellow trustees. I mean, we are fiduciaries to this fund. And for a plan to be created that would essentially ask us as fiduciaries to give away the investment role of this board without including us flies in, as far as I'm concerned, flies in the face of that fiduciary duty. My second point would be, I completely appreciate the importance or the consideration of an elected official being concerned with decisions that they make affecting, what goes on 20 years in the future. But that's what the people of New York elect our principals to do. It wasn't an easy decision to, come up with the entire Brooklyn waterfront rezoning. That wasn't for tomorrow or today. It's for the next 20 years. It is an easy decision to displace people to put an arena in the middle of Brooklyn, or to do whatever other decisions that elected officials are elected to do. That's part of the accountability aspect, I feel, that the people of New York have elected the controller to do. And so I appreciate the concern in regard to we want to make the right decisions. But the people of New York elected this person because they had the confidence in this person to have at least choose the people to make these decisions. And they elected him, or whomever that elected official is, to be accountable for said decisions. And so while I can see how it can be thought of as political courage, I still question whether or not it's faithful to the voters who actually elected that official to take on these duties.
Are we wrapping up?
I'd like to, but of course, if there are questions in the room.
All right, well, then I'd like to just say a couple of things. I have sat in pension fund meetings for 25 years, and I have never questioned the sincerity, the level of education, and the goodwill of a series of investment advisors about what the pension fund should do with their money. In 25 years, they've been wrong a lot more than they've ever been right. And I'm not blaming that on the individual manager. As we all know, it's been 150 years since bonds outperformed stocks for a 30-year period. We live in a very strange time the last 30 years, so it's a tough way to make a living. But I have a great distrust for what I call the Wall Street mentality, which is we know better than the people who don't know the technology that we have, who didn't go to Wharton, who didn't go to Harvard Business, who didn't spend their lives making money. The people around this table spend their lives, doing things for people and making a living in many other ways, and they bring a perspective and a judgment to that process. And the concept of turning $120 billion over to some Wall Street types
No one's
so they can make the decision.
That's not what's going on here. So I don't want the record to go along. That is not what I have said, and
Well,
so
we're talking
no
about-
one has said that. So I
I've
just
not
want
interrupted
to,
you.
Madam Chair, with
I
all
have
due
not
respect, I don't want to. No one's suggesting turning over to 120
We're
billion.
talking about
to anyone.
eliminating public accountability.
No, I said
That's what we're
every
talking
about.
public.
Eric, let's let Larry finish, and
Okay,
then you
I
have
just
absolutely your
I want to be concerned
Understood.
for the
We'll have
record
your
that
time.
we're not casting this burden. No one has said anything here about outsourcing $120 billion to Wall Street executives. In fact, I've said we want to build a pension staff, public employees for the next 70 years to be world-class. 1, 2, I said we want to insource some of those assets currently being managed by 362 Wall Street professionals and 15 consultants. We want to insource that. We want to pay public employees. We want to pay public employees some portion of that $440 million that you paid Wall Street last year. We want to build in the world's financial capital a best-in-class, public employee, staff-driven organization. And so this is not about outsourcing anything to Wall Street. And I've heard that, and I just want to be clear, lest anyone believe that that's what I've said. That is not what anyone has said. That is not what I have said. And so I can only speak for what I've said, and that's not what I've said today. And so I apologize, Larry, and I apologize, Madam Chair, but I just, I don't want to, because if you repeat something enough times, people believe that that's in fact the perception. So I just wanted to be clear that we are not outsourcing anything. We are insourcing from Wall Street, not outsourcing to Wall Street.
We have today witnessed the mayor trying to move the people out of Liberty Square because basically they're protesting what Wall Street has done to this country. That's what people feel. And that's the context we live in. I'm not opposed to eliminating an RFP because I think the process should be long. There are many ways of getting to 7. But I have opposed eliminating the RFP process because I think you need to be sensitive to the perception that things aren't being done in an open and above-board way. I am talking to you not about what you're saying. I accept your sincerity completely. I think you are saying exactly what you believe to be the case, and I don't question that at all. But at the end of the day, I am very suspicious about a process that was put together behind the board, behind the back of the board, to eliminate our investment authority and to transfer it to another entity that we haven't quite figured out. At the same time, we're going to give up public accountability in terms of who that person is, where the comparisons are made in the press to Harvard and Yale, where if you look at the numbers reported in the New York Times about what they did, they overstate what Harvard and Yale did for a 10-year period, and the Times understates what the pension funds did for a 10-year period. How the New York Times could get such misinformation, I don't know, but that's the misinformation they published. You have to recognize that there is great suspicion, not just by me personally, but the public.
Fair point.
In any process that appears to be giving it to Wall Street.
Fair point, Larry. Fair point taken.
Thank you.
And that perception will be magnified to the extent that their qualifications for the board that require them to be Wall Street.
Fair point.
And when you add that with when we professionalize the staff, okay, when the staff is professionalized, that means we'll be paying higher salaries, and a lot of these people will be from Wall Street.
Yeah, but Al, you accept the premise that we can't have a staff as competent that are public employees as you do as, I just left the street. I've been at Citigroup for 6 years. I've been here for 18 months. I am as great a leader here as I was there. I just happen to be a public employee now. And so I don't accept the premise that paying some percentage of that $440 million to public employees.
Myself,
but I hear and I understand the trust issues, and again, you have to charge it to my head, not to my heart. The intent here is simply to do those things that we've talked about earlier, to lessen the cost, reduce the taxpayer burden, and protect and ensure, most importantly, the public employee benefit moving forward.
But I have to say, the qualifications of the board set up, the salary, you can call them public servants. I don't have anybody in my union right now that I know that will meet those qualifications, that we can call a public servant that won't have ties to Wall Street. And the perception, and sometimes perception is reality, that they will have this connection to Wall Street. And we know how that played out with AIG, with Lehman Brothers, with Bear Stearns, with the other firm that Corzine just finished demolishing. We know how that turned out. And I'm afraid that we have real capital right now, $120 billion. And tomorrow we can have nothing and no say in it. And what will our members have to live off?
So
20 years from now, I want to be a retiree from New York City. And I don't want to get a letter in the mail saying, Mr. Floyd, due to our poor performance, your pension benefits have been cut in half. And I won't have anybody in this room, I won't be able to find you.
I'll be there for you.
I mean, there are real concerns here. And I'm increasingly over-concerned because I am one of those people that will depend on this benefit. And I would hate to kill myself because I made a decision that hurts me and everybody I love going into the future. So you got to understand the passion. I guess I qualify for the board because I have passion.
I do fear that we are at a point where we are repeating ourselves. So let me close this conversation as follows. First, thank you for coming, Eric.
Thank you, Madam Chairman.
Addressing the very real and thoughtful questions posed to the Comptroller's Office by members of this board. I think it's fair to say that the passion exists in this room for transparency, but also for inclusion. And you have heard very articulately expressed concerns on all of those fronts. So this is by no means the last conversation on the subject, formally or informally. So
Yes,
we
ma'am.
look forward to having you back. I would urge everybody to go to the PIR NYC website because there is some useful research, and I hope that you will keep posting to that website. I think members should feel free to contribute, pro and con. I'm sure you will welcome any additions. So a good conversation. I thank everybody for staying through it without a break, and we will actually take a break. So thank you, Eric.
Thank you for having me.
Thank you. Thank you.
go. CO 62-290. No title. Take one.
Karen, do we have a quorum?
1, 2, 3, 4. Yes.
Okay.
Wait, one second. The water company is leaving unless someone wants them to stay.
I always welcome our company and say goodbye.
I didn't want you to think I actually already left.
So if there's any issues that you want her to stay, she'll stay, otherwise.
That's the plan.
That's the block.
The available
block.
This is only
John
about
Sally.
Yes. So we are still in public session. The cameras are still rolling. Our visitors are still with us. And Larry, over to you.
Over to me. Okay. So let's go through the monthly results. Does everybody have one of these? One of these? Mark, you have extras?
Yeah.
No.
Someone lost their glasses.
They'll be back.
Someone find. Okay, so we'll skip the economic section since I thought Rebecca did a nice job. Let's go to page 21. And because it's afternoon, literally afternoon, well, I'll see if I can go pretty fast. So the takeaway from page 21, which is the VIX, which is volatility, is it's up. It's been up since August. And as Rebecca said, expect it to stay up for a while. Page 22 is the yield curve. The relevant yield curve is the white line. And you can see year-end last year, the pumpkin color line. The Fed's working hard to get rates down. They're working harder now on Operation Twist on the longer end because they want to promote growth in mortgage refinances primarily. You can see the 10-year Treasury on next page, page 23. Again, I would tell you, my hot button is when it gets below 2%, a 10-year. Risk is really pervasive. When it floats around a little bit above, that's a little more normal in these strange times, but the reality is it's not supposed to even have a two-handle on it. So we're at the mercy of the Fed. If you look on page 24, you can see how risk is backed up. It's the spread, the high-yield spread, which is now 667. If you recall, we sold a large number of our high-yield bonds when rates were sort of around 6.5. The high-yield index is now about 8.5, and it went up to 9.5. So it's a good time to sell, and I'll come back to high-yield in a second. Next page is the earnings. Corporate earnings are going up is the blue line on page 25. And the green line is the S&P 500 multiple, and again, reasonably inexpensive on the long run.
Larry?
Yes?
The significance of these two indicators over the years since the green and the blue moves around a bit from blue and green.
Yeah. Over the years, you can see that when the S&P 500 multiple, the green line, I would say it's an indicator of valuation and cheapness. So roughly 15 times. If it's below 15, they're kind of cheap. If it's above 15, they're kind of expensive, and it's either more cheap or more expensive. The problem, of course, is it's really programmed in projected earnings, which is always harder. This is trailing. So in times like now, when projected earnings might slow down, if you buy those same multiples, you get yourself to lower stock prices. So that's the future. We'll get to that in a second. On 26, the blue line here is this whole chart is laid out to coming out of the recession. How do we stack up compared to other recessions? This is the blue line. Corporate profits aren't not the problem. U.S. corporate profits, they've risen nicely. The bad news is they've risen nicely partly through the layoffs, which is why unemployment is so high. but it's not a corporate profit problem, which has been some of the problems in other recessions. Page 27, a little bit, Pat, back to what you were talking about. These are the multiples, the yellow boxes are the multiples of projected earnings of the Russell 3000, IFA, and emerging markets. Again, they all are reasonable to inexpensive on a longer-term basis. The question is, it's all about risk and volatility right now. Similarly, if you go to the next page, you can see how the large cap, small cap, and mid cap are. Not in that order. It's large, mid, small. And again, we keep track of this just as the barometer on when we think things are inexpensive versus expensive as to how we should have our asset allocation. I would have you flip right now to page 37. This is September results. So if you go to page 37 and you look at the far left-hand column, September was a terrible month. Okay, so if you look at the block at the top, this is the U.S. stock market was down anywhere from 8 to 11%. International markets were down anywhere from, call it 9 to 15%. So these numbers are going to be bad. The good news is when we come back next month on the next page, page 38, the stock markets were up more than they were down in September. So it's a little bit, take this with the rest of the report with a pound of salt, because this volatility has played 100% through our portfolio. So September, which is these numbers, were bad. They're made up in October. When we get back together next month, you'll see the October numbers. And I'll try to give you a glimpse in a second. So now if you go back to page 29, the white line, which is the top line, is the Russell 3000, then you have IFA, then you have emerging markets. And if you look at the bottom, you see it says 16 September and 7 October. Right about the very nadir of all those was the end of September. So again, we're picking up the bad part. If you roll your eyes forward, you'll see that the valuations go up. And again, public equities are probably 60% of our portfolio. Actually, a little bit less than that, probably 55% right about now. So down this month, up next month. How does that impact us if you jump to page 31? Actually, better to go to 32. 32 is a rolling 12 months. So at the end of September, it was $37.3 billion, but I'd have you write down 39 plus billion, which is where October ended. So again, we're way up off of this bottom, particularly because of the numbers I just showed you. I'll call it 39 billion, so we're down about 5 or 6% off of year end. Now, if you go to the next page, remember, we're going from, this is page 33 now, we're going from this asset allocation to the next page's asset allocation, because we've approved those. We're going to talk about the ranges in the asset allocation. So we're a little bit in flux. And because we're in flux, we started to make some moves, as you may recall, and then we sort of stopped because of the volatility. So our cash position was the highest at the end of September at 8%. Since then, we put 1% into the high yield market. Again, recall that we sold things when the high yield market was sort of 6.5. Now they're sort of 8.5 to 9. So we sold at a low price. Actually, we sold at a high price. We're buying back, hopefully, at a low price, and things should work themselves out. So we make some money. So we put 1% into high yield. We've also put 1% into emerging markets. So we're down to 6. The denominator is different because, again, the fund is up from the bottom, so that gets us into what I'll call the high 7s. We have about 1.5 to 2% that we're going to move into the previously approved opportunistic fixed income that we're just waiting on the documents. Martin's working on that, but we haven't been able to put the money in, but we've had the cash ready. We should have the money to work by end of the month, starting to work at the end of the month, right? Clearly in December.
Maybe put it in the spot, but yes.
Yes, I wanted you to be on the spot. Yes, we're going to get the documents done. So the cash number is really heading down below 5 again, and then again, as the markets calm down, you'll see us going to this next page, which is 34. So, again, we're going to talk about these ranges in a second, but if you were to look at 34 and take these ranges with a little bit of a grain of salt until we agree on them, the U.S. equity market is pretty much in the range again for the high end. EFA is pretty much in the range. Emerging markets, we put 1% in now, so that's getting closer to the bottom of the range. Hedge funds we're going to start talking about. SEMA's going to come next month with our first recommendation of direct hedge funds, so that's the minus 3.3. That'll take some time. The rest are generally close. Real estate always lags. And then the chartreuse color all the way at the right, which is opportunistic fixed income, we've allocated 3% already. So it's a question of the managers funding out their allocations, so that should be pretty much in line. So we don't look, we've embarked pretty quickly, I would tell you, on what takes 12 to 18 months of going from one asset allocation to the next. So we're not as out of allocation as you might think, again, going from page 33 to page 34.
Actually, Larry,
yeah.
could you give us the prognosis on the cash? We're at 8 now. How long do you think we're going to be there?
We're actually now at about 5.
Oh, okay.
Okay, because take 1% off for high yield, take 1% off for emerging market that already happened,
Okay.
and take 1 to 2 off for his opportunistic fixed income, which is a document thing, and then they'll take it down. So currently we're below 5.
Oh, okay.
Heading south as the markets stabilize a little. Because again, what Rebecca didn't dwell on, which is okay for her not to dwell on, is if so many things go wrong. You can have a real mess quickly, and so we're trying not to put our money in just to watch it evaporate because of some event either happens in Europe or some event that happens when this committee comes together at the end of the month or doesn't come together at the end of the month. So I think we're sort of in a reasonable place.
After listening to Rebecca, I feel I have another degree. She was phenomenal.
She was good. I liked it.
Yeah, she was great.
But I didn't like that half the GDP of the world gets new elections in the next 12 months. That's a little breathtaking, especially when most of them are going to change. She didn't comment on the U.S., which is probably a smart thing for her to do.
Yeah, I think so.
Right?
I wouldn't worry too much about Chinese elections.
Yeah. Or Russia.
Some outcomes are predetermined.
Yeah.
Yeah.
So if you fast forward to 36, in the 1 month over on the left, we lost money as expected. Remember, if you go back to the chart I showed you on the stock markets, U.S. stock markets were down 8 to 10%, and international were down probably 10 to 14. So we were down basically 4.5 in our equities, or actually 5, let's call it, in equities, which is pretty much what we were down. And again, recall the following page, which was October, we wrote about the same. So you roll that forward, our fiscal year to date is down 9.5. My guess is by the time we get back together next month, it'll be down 5, let's call it. Which for all the volatility, I would tell you, is not too bad, all things considered. The rest of the report, if you start on page 40 when you go through the managers, there's a lot of red relative to indices. But we're not too worried about the red because with all the volatility, 1 month is too short. You can easily get flipped here and flipped there. So I'd focus more on the year-to-date numbers for people doing better or worse than their benchmarks. And again, this is a very, very treacherous time. You know, the stock market goes up 3% one day and down 3% the next day. So, and we mark these things at the day the month ends. So if that was a down 3% day, our results look bad. If it was an up 3% day, it looked better. But again, we're sort of this is the end of the first quarter. So for the first quarter, I'd say we're down this 9, but it's really closer to 5. And again, we'll see how we do. So that's the overview. Seema, do you want to make any comments on the equity managers?
No.
Martin? Yvonne?
No.
Barry?
No.
Okay. So if anyone has any questions, otherwise next month you have much better numbers to look at.
One quick question.
Yeah.
What
page you on?
Sorry, on page 43, the activist equity. We're cycling out of those, aren't we?
Yes. The problem, we approved getting out of it last year. The problem is we're locked up. So we told them we're out, but I think we can officially get out, I think, next June. Next June, SEMA, for free? Does that sound right? March?
I think that's right.
June or March. It's just the way the document's read, you're locked up.
So we ride the roller coaster until then.
So we're stuck, yeah. We're stuck in a place we don't want to be. Any other questions?
Only with regard to the person who presented. I mean, did you have any generalized reaction?
Rebecca?
Yeah, any reaction to what she was saying?
Yeah. We're moving into high yield now, right? So I totally agree with her on high yield. She endorsed basically our move to opportunistic fixed income also, because that's the same theme, that you got to get some return. There's a lot out there that's getting stressed or distressed. We're moving our money to, some of the opportunistic is going to move to non-performing loans in Europe, so it's going the right way. We're going to increase our exposure to emerging markets. SEMA's finishing the emerging market manager RFP next month, right?
Right.
So we're probably generally in the same direction that she was talking about. I don't think there was anything on there that she said go left and we were thinking of going right.
And her general prognosis
Of volatility.
Of Europe itself. I mean,
Europe
limitations on impact.
Yeah, I think Europe is going into recession. She said mild. I'm not so sure I'd buy the mild yet. It's too soon to call. They could screw this up royally. It's not every day that you have two presidents exit the same week, and it's not election time.
Right.
So the people that are there are temporary. Not clear how that's supposed to play out. I'd like to believe, if I was the optimist, that they sort it out right, but they sure are taking their time. If you look at today's paper, for instance, there's a big Italian bank that decides they need to raise $15 billion of equity. That's a lot. And again, if you contrast what's going on in Europe versus what we did in 2008, we might have made some mistakes the Treasury might have made some mistakes along the way, but they finished. This agony is it's terrible for investing. And as much as we're long-term investors, so we're trying to have an eye on the long term, which is why we look at some of these equity valuations. You have to be a little prudent also as to when you make investments, because the short term can kill you while you're waiting for the long term to help. So I think we're directionally in the right spots. And as to Europe, I don't have any inside crystal ball. I can tell you we've talked to a lot of our biggest, smartest money managers, and they're all worried. Or I went to some event and I heard Alan Greenspan speak. I've heard a whole bunch of great, knowledgeable guys speak, and they're all worried. No one is saying, aha, I figured the way out, or aha, they're working on the way out. There's just this anxiety that's out there that's too palpable not to feel. And, look, I think Rebecca put it well. They came out with a plan. The stock market was up hugely, and then everybody read the plan and said, oh, shit, that's not really a plan. And then it went down hugely the next week. Now, that's very, very problematic.
Mark?
Yeah, I guess a couple of observations. I'm glad you asked the question about Rebecca, because I think there's a couple of observations to make. One of them is that as a market strategist of sorts, market strategist needs to have views as to what they think the market is going to do. And I think it's important to take those in the context of just that in terms of managing a series of views and then how you implement it in a long-term plan that you've got. And so I think one of the things Larry talked about is based upon views of the market, Dan will be making movements around
your asset allocation in a way that's prudent, but not in a way to completely void you out of an area. I think the second one that was more important, because I appreciate what you have to say about Europe, is one of the things I think you need to recognize in your asset allocation is that, in fact, you have already relatively significantly underweighted Europe relative to the rest of the world. Part of that is because of the basket clause issue, that they were allowed to have a certain amount in non-U.S. equity. And so part of your allocation was a decision as to how much to have in emerging markets where, in fact, the expectation is that the outlook is better, the growth will be better, the returns might be better, and how much to have in developed markets. And so you've overweighted emerging and underweighted developed. One of the impacts of that is that Europe, just by nature of that, is relatively significantly underweight relative to its weight in the world. So that's one of the things you've done already. The second thing, and this is obvious as it relates to the investment managers, is their own decisions as to where to position the portfolio on a stock-by-stock basis. And in fact, most of what we've seen across both managers has been an additional underweight to Europe relative to the rest of the world. So I think it's, that much of what she has talked about, either by policy or by investment managers, has in fact been here.
Okay? Okay. Thank you. So that gets us to our rebalancing ranges on the new asset allocation.
On page 63 in your book, I really won't spend too much time on this because you all will remember that we presented this memoranda at the September meeting, discussed most of it. What we have done is updated this based upon discussions that took place at that meeting, incorporated a couple of extra things, and still left one answer, one part of it still to be determined and still to be answered. So I'll just comment very briefly on what the changes are. But again, the purpose of this is to try and establish what will the policy be with respect to rebalancing around your policy asset allocation, and where in fact you might decide to hold assets that are ultimately targeted for another asset class, as Larry referred to earlier. Where do you hold assets that are targeted for opportunistic fixed income? Where do you hold it that's targeted for real estate? That is that issue of sort of the holding places for assets that are ultimately targeted elsewhere is the one issue that I think is still open on the table. We've suggested that there's still more work to be done with respect to between BAM and the individual consultants to reach that in terms of a policy. And so that, which is outlined in number 4 in this memoranda, is still an open item. The other three, though, I think have resulted in some changes from where we talked about last time. And I'll point to the places where that is. First of all, in item number 1, the very last paragraph, we continue to believe that an allocation of 6 to 7% in non-U.S. equity to emerging markets is reasonable to NYCERS. In our memoranda last time, we showed 6.5% simply as a midpoint. I believe that BAM has proposed an allocation of 10% to developed markets and 6.9% to emerging markets. We are on board with that proposal. Whether it's 6.5 or 6.9, frankly, is a minor issue. But at 6.9%, 10% to developed, we're on board with that proposal. And then in item 3, the one additional change in this memoranda from what we presented in September, again, the very last paragraph, which is on page 65 in item 3. We did not address the issue of cash, and Larry referred to that in his review just now. Our general belief is that cash should be minimized so that you preserve the integrity of the asset allocation. There wasn't part of the asset allocation was not to hold cash as a long-term target. However, cash is needed for liquidity purposes. Cash is needed to fund new commitments. And so for most of our clients and in this board, we would represent that 0 is the long-term target allocation to cash. But we think for purposes of opportunistic investments, funding new commitments, making sure that you have assets for liquidity, that an upper range of 5% is probably appropriate and would suggest that. Other than that, the memoranda and the recommendations are the same, with, again, the idea that item 4 that's shown after that is still something that needs to be worked out.
Just a couple of things. One is our current investment policy statement has broader groupings for equities and fixed income, and that had been discussed last time. So we would very much like Callan to include ranges around the risk bucket, so to speak, and the way we had talked about it with my fellow trustees last time was our concern, which is just a mathematical construct, that if we were at the max or the min for every subcategory, we could be in gross violation of the total equity or the total fixed income limits, and we don't want to do that, because truly all of these rebalancings are all about the board's expression of the amount of risk we want to take around our policy portfolio. And if we ignore that, we end up in a strange position. So just number one, like that, we put back in. And we're glad to hear you articulate that the strategic allocation for cash is 0. I think we allow for 1% in the IPS. And this liquidity issue is truly one that needs to get addressed more through the where cash will be parked, a discussion that we still need to have. So, and we're waiting for BAM to syndicate all of our consultants' views, because just for my fellow trustees, everybody has a different perspective on where opportunistic or hedge fund cash should go, and we need to have one system view. And I guess the last point from us is the way our opportunistic fixed income IPS is written, it's written to be 0 to 5. So we've actually prescribed the range, we've prescribed the max, and then to have a max or a range around that just doesn't make sense, because that was written, quote unquote, for it to be opportunistic. So that's not a target allocation that gets a rebalancing range. It's 0 to 5. And so I would just stick to how we've written it at this point and not manage around the max, which we've already prescribed as a board.
On the opportunistic fixed income 0 to 5, the problem with it is 0 to 5 is your target. It's a little bit like all these targets. You pick a number, and I would tell you, you need to have a little headroom in your target.
Or you don't get to the target, right? You say
that's exactly right. You never get to the 5. Which is,
but that's
like all these other numbers, you're trying to get to a target. And you'd hate to have, I would hate to have us be opportunistic, get to a target, and then have the portfolio go down, right? Because for whatever reason, you get the denominator effect kicking in, which might be just the time you want to be an opportunistic fixed income, and all of a sudden we tell opportunistic fixed income guys, sorry, we're stuck by this denominator effect, we want you to sell. I just don't think that's achievable what we all set out to achieve with the opportunistic fixed income.
So completely agreed, but you could just be at 4. So we had this conversation when we did the IPS. That's right. But the 5 is to allow you to get there in a market with market volatility. So we had this conversation when we spoke about the IPS in great detail, if I remember. And essentially it's to say, account for the volatility of the sector and manage this in a way that we don't violate the max of 5%. So that is what we told them. So just manage it to
I don't think that's what Dan heard. Well, I don't know. I'd have to read the record. I'm not sure that's at all what we thought.
I wouldn't get so hung up. I just think that the 0 to 5 was written that way. We didn't write 0 to 7.
No, we wrote 0 to 5, and then we presumed that there'll be some range in case you get over the 5. Because again, we're going to put this capital out. Our target was to allocate 5% to the managers. Therefore, we will be over.
Well, then we have to rewrite the IPS, and I'm just not sure why we would do that.
Well, what do the other members think? What are we trying to? Oh, I don't know. I guess I'd ask you first, Mark. What are we?
Well,
what we're trying to get to?
I guess I'm not sure what the IPS says. So I'll start with that. I guess I would come from the standpoint of what the asset allocation did, and the asset allocation targeted a 5% allocation opportunistic. And so I guess philosophically, I agree with what Larry is saying about this from the standpoint that if 5% is the target, then there should be a range around that to include upper or lower. In what we suggested here, we actually, this was the one area that I think we may have had unsymmetrical because it's opportunistic. But if the idea on reexamination is that the maximum this board wants at any point in time is 5, then the target should be 3.5 or 4. It seems to me, but so I'm not necessarily opining. I think the difference between a 4 and a 5% allocation from asset allocation is not going to be significant. But I think this is a policy decision that needs to be reached, and the 5% asset allocation target assumed a 5% long-range plan, which by its nature could be higher or lower based on market action.
So that's a broader question for all alternatives, right?
It is.
And again, we set targets for a lot of these things, and there isn't a rebalancing around alternatives that is generally proposed. It's not as if BAM gets to 7% on private equity and says, oops, we are rebalancing now because this has happened. So to me, this falls into that category. And anyway, Pat?
Well, there's a couple of things, the volatility of the markets, I guess, but the other thing would be, how often does one rebalance? I mean, that's the question. How often does one rebalance?
Well,
I think you use cash flows to rebalance every time there's a cash flow, right? You don't want to trigger a trade, a buy or a sell. You do it every time you have a cash flow. So the answer is every time there's a cash flow, all the time, in some ways.
You're constantly rebalancing.
But you're not selling or buying. You're just adjusting to pay a bill, or because you got a cash inflow from a manager for dividends or income, or so it's just a constant, or in the alternative case because of an exit, which we haven't had much of.
So it's indeterminate depending upon the cash flow.
Dynamic, yeah.
Let me I would phrase it a little differently. The we would be BAM, okay? It rebalances itself all the time. Maybe it's where Ron and I might be different a little bit. It rebalances all the time based on the market. I mean, the numbers are different, right? Every day is different, inflows and outflows. The act of rebalancing itself, we do monthly because, at a minimum monthly, because NYCERS is cash flow negative, right? So you have to have some cash from somewhere, and your first blush is, all right, you look at the assets, who's at the highest end of the range to rebalance down and raise money. So that's the first place you look at. The second question you ask to that, well, do you like it up there? It might be we did that on purpose. And then you say, well, if we like that one up there, go to the next one and say, well, why is that one at the high end of the range? Well, just because maybe the assets grew. Okay, then rebalance that one down. So once a month, and Martin does an excellent job of this, we have to raise money from somewhere, and that's a rebalancing decision. Away from that, much more rarely we'll actually do a rebalancing event because of markets. So I would tell you monthly for cash, and much rarer to make investment decisions.
I have to confess I'm not following the discussion all that well. Is this discussion about the 8% in cash that we had for a little while?
No, the discussion was about the range. We have all the numbers that we have on the, if you go back to the asset allocation, right, they all have a number.
Right.
Everyone has a target except for opportunistic fixed income, which has a range. Everyone has a target number, and then a range around that. If you get outside the range, why are you outside? You should rebalance. The problem with opportunistic fixed income is the definition is it's opportunistic. So it might go to zero just because there are no opportunities, right, which is fine. What Ranj and I were just talking about was if the range is 0 to 5, and we think that the opportunity is on now. So we think, again, all these managers that we've looked at, we think it's a great time to be in these opportunistic fixed income managers that we've had, like the guy who's coming in later today. To do distressed debt or non-performing loans in Europe, things like that. We were under the impression that the 5 was the target. And if the 5 is the target, we're going to go over the 5 depending on the ups and downs of the portfolio value. What Ranji's saying is that's not what we agreed to. The range is 0 to 5. Stay under 5. To stay under 5, we will only allocate out 4 then, as opposed to the 5. And I think what Mark is saying is he sort of understood it the way I understood it, which is at 0 to 5, and if you have, which is what he has here on page 65. If the target is the 5, you should give yourself a little room on top, which gets you to maybe 7. That's what
Well,
Ryan
7
and I were doing.
assumes a huge level of volatility, and that those numbers, you need to be careful throwing these numbers around. But let's come back to it, because, I mean, arguably it's 4.5, because I think we've allowed 10% volatility for opportunistic and 10% vol, 12% vol for the portfolio. So we need to think, if you're thinking 4 standard deviation events, it's a whole different kind of, these ranges don't hold. Mark, you've also ignored private equity.
We did, and for exactly the reason you talked about earlier, Rodney, the private equity is essentially a privately valued asset class. We think that in large part needs to be worked through the process of working with your private equity consultant in terms of patient study, in terms of allocating in order to achieve good year diversification, but also with an eye toward what the ultimate target is. One of the things you'll remember is that in the 08-09 timeframe, especially late 08-09, private equity represented a significantly higher proportion of the fund because of the denominator effect of what happened, that every other asset class had been marked down, but private markets had not. And so we think that a range of private equity, the target for private equity needs to really be invested at based upon the pacing study with the private equity consultant and how much should be allocated. We're not sure that rebalancing ranges on that. I think we could put something in, but I'm not sure they're actually meaningful.
So then help me with real estate. All of that applies, right?
It doesn't apply in much the same way. Much of real estate is in fact independently valued on other than an event basis. There's cash flow in real estate that takes place. So real estate, we think, is different from private equity in terms of the recognition, if you will, of gains and losses. Real estate is in many cases valued by independent appraisal, and that reflects through in the value of the real estate itself. Where on private equity, it takes place at an event, either at sale.
Do we mark to market now, Larry? Don't our managers have to do that? Does it list as 157?
Yeah.
All right, so maybe we'll come back and round out on a couple of these fronts. But again, looking forward to getting a synthesis from BAM on
Right, we'll try to get
think about
everybody next month. Just a quick comment on private equity and real estate. Range versus a number. Even though you never get quite to the number because the markets bounce around, the transaction cost to actually overtly rebalance, to sell private equity or to sell real estate is very expensive. So you really don't tweak it much. All you can, we're tweaking ours for different reasons than rebalancing, right? But you couldn't really, and you only really talk about rebalancing private securities if you get into a real market meltdown like 08. Like I'm sure at 08 you all had a conversation that said, look, the portfolio's down 20%, our private equity allocation just went through the roof. What do we think about that? Which is, of course, the wrong time to sell it also. But other than that, you kind of get plus or minus a little bit, and that's as good as you're going to get on private markets because the transaction cost is so hard. So we'll have I guess in January, is private equity consultant going to be pacing for the calendar year?
Our target is January, February.
Right. But anyway, we'll come back on these ranges next month with sort of a synthesis of where we're coming to. Okay?
Very good.
So that ends the public agenda.
Okay. If there aren't any further questions, can I have a motion to go into executive session?
So moved.
Second? All in favor?
Aye.
All right, we'll break for lunch and come back at 1:15 there.
Yeah.